Can I start?
Yes, let me introduce you.
Yeah.
Very good evening, one and all present here. I'm Maitri and I'm here on behalf of SICASA. I'd like to thank everyone for joining our revision series, the Flashpoint Mastery. Today, tomorrow, and day after tomorrow's evening session will be on direct taxation, that is income tax law. For this subject, we have CAC Muthu Palaniappan sir as our faculty. He is an experienced partner at Vinod and Muthu Chartered Accountants. He's a technology, as he described in his Twitter bio. He's skilled in developing analytical tools in Excel and Power Apps that saved enormous times and increased efficiency. We are honored to have you here as our faculty, sir. Thank you so much for joining us. With this note, I request CA Muthu Palaniappan sir to start the session.
Yeah, thanks, Maitri, for the introduction. So let's begin with this. And as said, we'll be covering through income tax, your paper 4A. And when I say this paper 4A, this is the last time that we'll use the word paper 4A, because from May 24, it's the paper 3. So which also means that this is one last time that we're all going to clear it this time, and so that we don't face any hurdle in the new syllabus as it is. So with that introduction, we'll first understand what exactly is this income tax all about. So basically, when you say income tax, we'll understand that we all know that it is split into 5 components. So first, we'll be discussing about the basic concept, residential status in the scope of total income, which carries your 25% weightage. And then you have your heads of income, which carries your 35% weightage. The third portion will be your clubbing, set off, and carry forward and other things. And the last one will be about the computation. And I have also given the weightage. And when it comes to your importance, income tax at this intermediate level wants you to understand the law as it is. So they want you to know the provision. They want you to interpret the provision and calculate. So they don't want anything beyond that. So these are the 2 requirements that is expected out of the intermediate. So when we say income tax as such, so of course we have to start from the basic concepts, and we have to rush through. Of course, we'll have 9 hours over the next 3 days to cover all the portions. So we'll just share what is important during your examinations. We'll skip the part that is not important for your examination also. So with respect to these, we'll start with the basic concepts. So when you say basic concept, of course, we need to understand the tax rate. When you say the tax rate, we need to understand the old regime tax rates. So there is a slab. For the first 2.5 lakhs, there is no tax. And then for the next 2.5 lakhs, you have 5%. For the next 5 lakhs, that is 5 lakh to 10 lakh, you have 20%. And 10 lakh and above, you'll have 30%. And for senior citizens, the tax slab starts from 3 lakhs. For very senior citizen, the tax slab starts from 5 lakhs. So when you say senior citizen, there are 2 conditions. One, the person must be a resident. The other, the person must be 60 years or more. And similarly, when you say very senior citizen, the person must be a resident and then 80 years or above. So every point in time, the senior citizen and very senior citizen is applicable only for the resident as it is, and it is not applicable for non-resident. So resident could be ordinary or not ordinary, but it must be a resident. So that's the only condition. And the surcharge up to 50 lakhs, there is no surcharge. Above 50 lakhs, you have around 10% of surcharge. So, and then 1 crore to 2 crore, it is 15%. 2 crore to 5 crores, it is 25%. And above 5 crore and above, it is 37%. You also have a health and education cess of 4%. It's a flat cess. So on every income, it's not about the income. For every income, wherever there is a tax, there will be a 4% health and education cess. And there is an asterisk mark in this 25% and 37%. It's to tell that surcharge is restricted. Surcharge is restricted to 15% in case of dividend, short-term capital gain under section 111A and long-term capital gain. And when you say 111A, it is specifically short-term capital gain of listed equity shares and mutual funds. So the maximum surcharge is only 15%. And for long-term capital gain, for both property sale or any long-term capital gain, it is 15%. Why 15%? For short-term capital gain, the tax rate itself is only 15%. For long-term capital gain, it could either be 10% or 20%. So at the end of the day, since your surcharge is going to be higher than the tax rate itself, so you're restricting it to 15%. And we also have a concept of rebate where when your income is up to 5 lakhs, when your income is up to 5 lakhs, you get 100% rebate. So if your income is even 5 lakh 100, even if it is 5 lakh 100, you don't get rebate. So the rebate is applicable only for individuals whose income is up to 5 lakhs. His income is up to 5 lakhs and it's not crossing 5 lakhs. So what is the rebate? It is 100% of income tax or the maximum of 12,500. So which means you're eligible for the entire tax as a rebate. So that is with respect to rebate under section 87A. And in certain cases, you have this marginal relief. So when you say marginal relief, it is basically to understand whenever your income crosses 15 lakhs, whenever your income crosses 15 lakhs, 50 lakhs, you have a surcharge of 10%. Now assume your income is only 50 lakh 1,000. Just because you have earned extra 1,000, you are going to pay surcharge on the whole amount. You are going to pay surcharge on the whole amount. But what happens on this particular portion? Just because I'm earning 1,000, I'm going to pay surcharge of some number which is more than 1,000. So income tax says, the act says that you will be provided with a margin relief. So what do you mean by margin relief? First step is to calculate excess tax. So first you calculate what is your excess tax, and then you calculate your excess income. What do you mean by excess tax? You first calculate it for 51 lakhs. Let's say your income is 51 lakhs. You calculate it for 51 lakhs, and then you calculate it for 50 lakhs. So tax on total income minus tax on base income. So this difference will be your excess tax. So the excess tax minus excess income will give you margin relief. So this concept is basically important. Everywhere there will be a limit up to what margin relief is applicable. So margin relief is typically applicable only when your tax is more than the excess income. What do you mean by excess income? The income earned above the surcharge limit. So if it is above 50 lakhs or 50 lakhs to 1 crore. So that is what you're calling it as excess tax or excess income as it is. And what about the new regime? Of course, new regime is about where for every 2.5 lakhs, there is a tax increase of 5%, and there is no higher basic exemption limit for senior citizen or very senior citizens. So it is a common rate for all individuals. So for every 2.5 lakhs, the tax rate increases by 5%. So first to 2.5 lakhs, 0, next to 2.5, 5, and so on, 5, 10, 15, 20, 25. So if you see, it grows in the order of 5% per slab, 5% per slab. So that's the increase. Of course, this comes with lots of sacrifice. We'll see all this in the respective slides. In the respective slides, we'll understand what are the exemptions available. So basically, as far as this new regime is concerned, if an assessee is having business income, it's a one-time opportunity. Once you have exercised, you have to follow it subsequently. If you are withdrawing, you can never choose new regime again. So this is the option for business people. For everyone else, I can opt every year. This year I am choosing new regime. Next year I can choose old regime. The next year I can again choose new regime. So it will keep changing. Every year. So what is more important is when it is business income, it is only once. You have to choose. Once you withdraw, you can never choose back. So it is not available. So these provisions, we'll discuss it later in the respective slides so that we understand it better. And we'll move on to the residential status. So when you talk about income tax, the first and foremost step, the first step of income tax is to identify the residential status. Only when you know what category of tax status you hold, your taxability is defined. So whether a particular income is taxable or not for a particular taxpayer depends on residential status. So what exactly is residential status? For individuals, there are 3 residential categories. You have resident, ordinary resident, not ordinary resident, and then you have non-resident. There is also another category, the 4th category, which is called as deemed residents. So when you say deemed residents, it is basically only applicable. Deemed resident is only applicable for individuals. And these are the 3 categories. That is resident, ordinary resident, not ordinary resident, and non-resident. So these are the 3 broad categories. The 4th category is deemed resident, which is only for available for individuals. A deemed resident is always a not ordinary resident. So how do you determine whether a person is a resident or non-resident or not ordinary resident? You have conditions, basic condition and additional condition. When it comes to basic condition, there are two basic conditions. If you satisfy one or both, you will be called resident. If you're satisfying none, you will be called non-resident. When it comes to additional condition also, you have two additional conditions. If you satisfy one, you will be called as one or both. You will be called as resident, not order resident, R and OR. If you are satisfying none of the conditions, then you will be called resident, ordinary resident. So these are the conditions between your basic and additional. Of course, we'll understand about these conditions. What exactly is basic condition? We said there will be two basic conditions. The first basic condition is, and when I say conditions, every condition depends on the number of days you have stayed in India. So the first thing talks about resident status. So when you say resident status, the basic condition is OR condition. So which means I have to satisfy one of the condition. I have to satisfy one of these conditions to become a resident. If I'm satisfying none, I am a non-resident. So what is the first condition? 182 days or more in the previous year. So if in a particular year, I am residing for more than 182 days, at least 182 days, I become a resident. Otherwise, the other condition is a UND condition, which means the second condition is split into first part and second part. What does the first part says? First part says that 365 days or more in the 4 immediately preceding previous year. So when I say EP, it is called immediately preceding previous year. So typically when you're talking about financial year 22-23, when you're talking about previous year 22-23, the 4 years will be from 18-19 to 21-22. So these are the 4 years you're talking. That is from 1st April 2018 to 31st March 2022. You should at least be in India. For how many days? 365 days. You should at least be in India for 365 days. So if you're there, you have satisfied the first part of the second condition. What is the second part of the second condition? 60 days or more in the previous year. So the second condition is divided into two parts. The first part is 365 days or more in the 4 immediately preceding previous year and 60 days or more in the previous year. So if you're satisfying both these conditions, then you have satisfied second condition. So once you have satisfied this, you will be called what? You will be called resident. If you have not satisfied both the conditions, if both the conditions are not satisfied, then you will be called as non-resident. And things to be considered is when you're talking about calculation, it should include both date of departure and arrival. Citizenship is immaterial. You're not going to be tested on these things on examination, but examination, you have to be careful. You have to include both the date of departure and the date of arrival. Similarly, the citizenship doesn't matter when it comes to residential status. So residential status depends on number of days stayed. It doesn't matter whether you're a citizen of India or you're not citizen of India, or whether you're born in India or you're not born in India. Now, when you talk about these basic conditions, we should also understand that there are exceptions. When you say basic condition, we said there are two basic conditions, but there are not just two. There are some exceptions. Whatever we saw is called general condition. So section 6, subsection 1, discusses about residential status, but there are some explanations given in this subsection, which talks about exceptions to this basic condition. So what are the exceptions? The first exception that we are going to talk about is specifically applicable for Indian citizen. Who is an Indian citizen? A person who's born in India and who holds probably the Indian passport or is basically a citizen, which means he has not obtained citizenship of any other country. So Indian citizen is basically person born in India and has not become citizen elsewhere. This person is leaving India. For what? For two reasons. Two reasons. The first reason is ship crew member. First reason is you're leaving India as a ship crew member. What do you mean by ship crew member? It is an Indian bound ship. It is coming to India or going out of India. It could be carrying passengers or goods or whatever it is, but it is coming to India or going out of India. It is an Indian bound ship. Now this ship, someone is traveling as a crew member. So when you're traveling as a crew member, the joining date and the last date in the ship. So the period in which you are in the ship, should be excluded from the calculation. So as a ship crew member, you should only include period where you are in the land. You should not include the period that you are in the ship. And the second reason is for employment. You are leaving India for employment purposes. So when you say employment purposes, we know some of our friends or relatives would have gone outside India saying that their company has deputed them outside India. So you are leaving India for what? For employment. So as a deputation or an employee as such, you are leaving India. So in this case, what happens is the only basic condition will be 182 days. So there are no two basic conditions. The only basic condition is 182 days or more in the previous year. So that's the only basic condition. Now, what about the second exception? Second exception, there are totally 3 exceptions. So the second exception is also for Indian citizen, but it is also for POI. POI stands for person of Indian origin, So when this person is visiting India, we have to consider what is the portion of income that is accruing in India or deemed to accrue in India, which means Indian income. Simply means it does not include foreign income. And such income which is taxed in India, that is the Indian income taxed in India, does not exceed 15 lakhs. So which means up to 15 lakhs. In that case, again, here also the only basic condition is 182 days or more. So the only basic condition is 182 days or more. Now, what is the third basic condition? The other part of it. So same, it's an Indian citizen or person of Indian origin. The only change is the Indian income is greater than 15 lakhs. The income is greater than 15 lakhs. What happens in the general condition? The word 60 is becoming what? Is becoming 120 days. So 60 is replaced with the word 120. So now the condition will be 182 days or more in the previous year. That's the first basic condition. The second basic condition has 2 parts. It is 365 days or more in the 4 immediately preceding previous year. That has not changed. And 120 days or more in the previous year. So when is this applicable? When I am an Indian citizen or a person of Indian origin with an Indian income greater than 15 lakhs. If this is the case, then the condition is 120 days instead of 60 days. The only change is 60 is being replaced with 120. So that's the only change in the condition. So these are the 3 exceptions to your basic condition. So if you are satisfying any of these, you will be called resident. If you are satisfying none of these, then you will be called non-resident. So this is what your residential status is all about. So now we know whether a person is resident or non-resident. Now we also said there is another category called deemed resident. So what do you mean by deemed resident? Deemed resident is considered as section 6, subsection 1A. So whenever you are not able to identify under section 6, subsection 1, through the basic condition, when you are not able to identify, you should check whether you are a deemed resident under subsection 1A. So what is a deemed resident? It is only for citizen of India. So it is not for person of Indian origin. It is only for citizen of India, and the Indian income is greater than 15 lakhs. And he is not liable to tax in any other country. For example, in November 22 exam, you had a question which talks about a person being a person from Dubai, who settled in Dubai. Now automatically is a citizen of India settled in Dubai. Dubai does not charge tax on individuals. So that's a country which is a tax-free country. So if that person has Indian income more than 15 lakhs, then automatically he will be called as deemed resident. So he need not come to India even one day. So when you are not satisfying the conditions, none of the conditions, which means you have satisfied none of the conditions of section 6, subsection 1, then you have to check whether you are a deemed resident. So this takes the first priority. So this is the first priority. If I'm not satisfying any of the conditions, then I have to check whether I am a deemed resident, whether I am a deemed resident. So that takes the first importance. And then if you have not satisfied one, you have to come to two and check whether you're deemed resident. So you must be a citizen of India. You must have an Indian income more than 15 lakhs, and such income should not be taxed in any other country. If you have satisfied all these three, you will be called deemed resident. So when you're deemed resident, you're automatically a resident, not ordinary resident. And of course, your ship, I told you, I already explained you that you have to exclude these dates. Exclude what dates? The joining date and the signing of date. So signing of date is the last date. So in this period, the period in which you are in the ship, you are not in the land. The period in which you are in the ship as a crew member should be excluded. I'll not take much time on this slide because I've already told you what it is. And the only condition is that when Indian ship, it must be going outside India or coming from outside India to India. So that's the only thing. And so with respect to this, we spoke about couple of terms: person of Indian origin and Indian income. So what do you mean by person of Indian origin? Person of Indian origin is basically either the self or the parents or the grandparents are born in undivided India. Please remember, they are born in undivided India. When probably India, Pakistan, Sri Lanka, Bangladesh are all considered as one single country. So that's what you're calling it as undivided India. Post-independence only, we split between India, Pakistan, and Bangladesh. So all this put together was one single country. So that is called undivided India. So if you're born in one of these countries, that is India, Pakistan, or Bangladesh, then basically either you or your parent or the grandparent are born in India, then you're called person of Indian origin. Moment you're a person of Indian origin, we saw some exceptions. That is person of Indian origin visiting India, person of Indian origin visiting India. Indian income is up to 15 lakhs. What is the condition? Above 15 lakhs, what is the condition? We said for up to 15 lakhs, the only basic condition is 182 days or more. If it is above 15 lakhs, we said the second basic condition will have replace the word 60 will be replaced with the word 120. 60 will be replaced with the word 120. So that is about the person of Indian origin. The next concept we wanted to understand is Indian income. So when you say Indian income, it's typically excluding income from foreign sources. When you say exclude, what do you exclude? You exclude income that is accruing or arising outside India, or deemed to accrue or arise in India, that is not deemed to accrue or arise in India. So which means there is no connection to India. So such income should be excluded. What should be included? Income from business controlled or profession setup in India. Please remember the word. It is business control, not business setup. Profession setup, it is not controlled. So these are the two words that you should remember. So you should include business control from India, profession setup in India, and you should exclude any income which is not accruing or arising in India or deemed to accrue or arise in India. So basically, you have to exclude every income that is not your foreign income. So now once you know whether a person is a resident or non-resident, you have to come to section 6, subsection 6, section 6, subsection 6 to understand whether you are a ordinary resident or not ordinary resident, whether you're ordinary resident or not ordinary residents. How do you determine? There are two additional conditions. So the first additional condition says you are a non-resident. You are a non-resident in 9 out of 10 immediately preceding year. 9 out of 10 immediately preceding previous year. So what is the 10 year? Previous year 12-13, that is 1st April 2012, 1st April 2012 to 31st March 2022. Between this 10 years, if you are a non-resident in 9 years, you will be called not ordinary resident. Please remember, some of you would have studied otherwise. In that case, it will be 2 out of 10 years. 2 out of 10 years, you are resident. Now we are saying 9 out of 10 years non-resident. The other type of understanding this is 2 out of 10 years, you are a resident. So, and then you say less than 730 days. That means up to 729 days. So if you are in India, up to 729 days from 1st April 2015 to 31st March 2022, that is 7 years, 7 immediately preceding previous year. In this period, if you are in India for less than 730 days, that is up to 729 days. If you have satisfied this condition also, you will be called not ordinary resident, not ordinary resident. What is the reverse condition of this days? If you are in India for 730 days or more, 730 days or more in 7 immediately preceding previous year. So according to this notes that I have prepared, if you have satisfied one, you are not ordinary resident. According to this slide, if you have satisfied any one, you will be treated as not ordinary resident. If you have treated none, if you have satisfied none, then you will be called ordinary resident. There might be understanding which is ulta of this, reverse of this. That is 2 out of 10 years, you are a resident. In the last 7 years, you are in India for 730 days or more. If you have satisfied both these conditions, you are ordinary resident. Please understand, I am telling you the actual act. Actual act says these two. If you have satisfied one of these additional conditions, you become not ordinary resident. Otherwise, you will be called as ordinary resident. And there are also other two situations. So basically, if you're an Indian citizen or person of Indian origin and your Indian income is more than 15 lakhs, then we said there is a exception in the basic condition. What becomes the basic condition? 365 days or more in the 4 immediately preceding previous year and 120 days or more in the previous year. So you should satisfy both these two to become a resident. In this situation, if your Indian income is more than 15 lakhs, then if you are in India between 120 days, but less than 182 days, So if you are within this period and such income is not liable to tax in any other country, then automatically you will be called as not ordinary resident. And similarly, Indian citizen who is covered as deemed resident is also not ordinary resident. So basically, these are 4 different conditions. The first 2 are called additional condition. Then you have the third condition and fourth condition. If you're satisfying any of these, you will be called not ordinary resident. So otherwise, you will be called ordinary resident. Now, the second step, once you have understood what is your residential status, are you a ROR, are you a RNOR, or you are a non-resident, or you are a deemed resident, depending upon that, you can understand whether an income is taxable or not taxable. So the scope of total income is what we are going to understand next. So section 5 discusses about scope of total income. So when you say scope of total income, there is an income that is received. Received in India or deemed to be received in India. So in this case, it is taxable for all. It is taxable for ROR, RNOR, and non-resident. So income received in India or deemed to be received in India. Similarly, income accruing or arising or deemed to accrue or arise in India, same concept. It is taxable for all 3 situations. But when income is arising outside India, which it's not received in India, it's not deemed to be received in India, it's not accruing in India, or it's not deemed to accrue or arise in India, then in that case, automatically it is taxable only in case of ROR. It is not taxable in case of non-resident. But for RNOR alone, if such income is a business income or a profession income that is controlled in India or set up in India, then that income is taxable for RNOR also. So this matrix gives you a complete understanding of scope of total income. See, my slide deck will be very crisp and short, which will only convey what is required for you, specifically for your examination. So probably if you go through this in detail, you'll have a complete understanding of the law as it is. So now once you know the scope of total income, you can determine whether an income is taxable in India or not. But we said there are certain income that are deemed to be received in India, deemed to accrue or arise in India. So what is this deemed? So I need to know which of the income will be called as deemed to be received in India. So that is discussed in section 7. So deemed to be received in India talks about recognized provident fund where the contribution is more than 12% or interest is more than 9.5%. So these two are taxable elements. Even though contribution to provident fund, recognized provident fund is not taxable, it is not taxable only up to 12%. So any contribution in excess of 12% received by the recognized provident fund is taxable. Similarly, any contribution to national pension scheme, which is covered under section 80 CCD, anything which is covered under 80 CCD is also taxable. When you say taxable, it is deemed to be received in India, deemed to be received in India. And the last one is any transfer from unrecognized provident fund to recognized provident fund. So till today, I have an account in unrecognized provident fund. From tomorrow, I am transferring to recognized provident fund. Both the contribution and interest which is transferred will be deemed to be received. Deemed to be received. Imagine all these three, I am actually not receiving it in hand, but it is deemed to be received by me in India. So that is what you are calling it as Section 7. Now, the next concept we have to understand is deemed to accrue or arise in India. This concept is more important in final. There is a lot that needs to be covered. For your intermediate, all you need to do is understand the basics of this law. So when you say deemed to accrue or arise in India, for all of you, I only give you one suggestion. You have to look for a connection. You have to look for a connection in India. Somewhere there will be India about it. Somewhere there will be India about it. We'll see one by one. You will know and you will understand where is India in that. So first is any income accruing or arising from a business connection in India, which means I have a subsidiary office. I have a temporary branch office in India through which I am in US. I have a branch office in India. So I'm doing some activity from this branch office. I'm earning money. So which means the branch office is in India. So there is a connection in India. Properties in India. So there is a connection in India. There is any other asset, a share or any debenture or bond or whatever it is, it's in India. So if it's a share of Indian company, it becomes deemed to accrue or arise in India. If it is a bond purchased in India, it becomes deemed to accrue or arise in India. So some property or some asset or some sources in India, and such asset is transferred. I'm selling a share of Infosys Limited in India. I'm selling a share of Zomato Limited in India. So automatically what happens? Wherever I am, that income is deemed to accrue or arise in India. So this provision is exclusively for non-residents, to say that even though you are outside India, these income will be called deemed to accrue or arise in India because there is some connection in India. And salary is earned in India for rendering services in India or leave period, which I availed it during when I was in India. So salary relating to India, working in India, leave earned in India is also covered. Again, connection. There is some connection in India. Salary payable by the government to a citizen of India for service outside India. Where is India here? Government is India, citizen of India. So somewhere there will be a connection to India. Once there is a connection, such income will become deemed to accrue or arise in India, and it will be taxable for non-resident also. Dividend paid by an Indian company. Again, where is India? Indian company. Automatically it is covered. Income arising outside India by any sum of money. So it's a cash gift paid by a resident Indian to a non-corporate non-resident. So here also, where is India? A resident Indian is paying to a non-resident. So what is he paying? He's paying cash gift in excess of 50,000. So moment there is a gift provided, automatically it becomes income deemed to accrue or arise in India. So why do we say deemed to accrue or arise in India? Because we are trying to say, as a non-resident, income that will be taxable in India will be income that is accruing in India or deemed to accrue in India. So this is where we are discussing about these. There are three more things that we need to be discussed. There are three components which are called interest, royalty, and fee for technical services. For these three services, there are certain conditions. It is always not taxable. It is always not deemed to accrue in India. There are situations where it will be deemed to accrue in India. What are the situations? Payable by government to a non-resident. Payable by government. So where is India here? India is in the government. Payable by the government to a non-resident is deemed to accrue or arise in India. So who will pay tax? The non-resident. We are only talking about whether it is an income in the hands of non-resident or not. So it is an income that is deemed to accrue or arise in India if such interest, royalty, or technical services is paid by the government, or it is paid by a resident. It is paid by a resident except for the business outside India or any source outside India, which means it is paid by a resident to non-resident. Interest, royalty, technical services paid by resident to non-resident for what? For doing business in India or earning income in India. So there is Indian connection. Resident is an Indian, earning income in India is India. So everywhere there is India. So only then it is taxable. So which means it is, if it's outside India, if you are borrowing money for doing business outside India, interest on that paid to a non-resident is not deemed to accrue as India. So a resident to non-resident for doing business in India or for earning income in India. And similarly, one non-resident paying to another non-resident. One non-resident paying to another non-resident, again, for doing business in India or making any income in India. So this is also a bullet point. So this is also a bullet point. So these two situations. So basically here also everywhere there is India. So for interest, royalty, technical services, moment there is some Indian connection for doing business in India or by the government, it is automatically deemed to accrue as India. And for these three things, you don't consider where the service was rendered. So what need not be considered, whether or not. So it is immaterial whether the activity is carried out in India or not. Please remember, it is immaterial whether the activity is carried out in India. What is important is whether it falls under one of the three conditions. One of the three conditions. You have to see only these. The place of rendering the service or place of providing loan does not matter. What matters is, do they fall under one of these three conditions? Moment they fall under these three conditions, they become income deemed to accrue as India. So now we have understood section 6, which talks about residential status. We understood about section 5, which talks about scope of total income. We understood section 7, which talks about income deemed to be received in India, section 7. And then we discussed section 9, which is income that is deemed to accrue or arise in India. So these are the things that are important for understanding your residential status and determining the tax applicability, whether a particular income will be considered for income tax or not. They are not talking about whether tax needs to be paid. They're talking whether it is an income in India or not. They're only talking about the income. They're not talking about the tax part of it. So to know whether an income is tax, whether it is accruing in India or not, you need to section 9. To know whether an income is received in India or not, you need to see section 7. So on seeing this, you will understand the scope of total income. Moment we have understood the scope of total income, of course, what we need to understand? We need to understand this matrix. So this matrix will give you a complete picture on whether or not this particular income is taxable. Okay. So we'll move on to the next topic. We'll move on to the heads of income. So heads of income, of course, we all know there are 5 heads of income. We are going to start with the most important topic for your intermediate exam, which is salary. So out of the 5 heads of income, one of the most tested chapter will be your salary chapter. So we are going to start this with respect to salary. We are not going to get into the basics of what salary is and all. So we'll directly get into the components of salary. So when you say components of salary, there are basically 3 components. It will include salary. It will also include perquisites. It will include profit in lieu of salary, because section 17 talks about how much of salary is taxable. Section 15 tells salary is chargeable to tax. So section 17 tells you what all is salary. 17.1 is salary. 17.2 is perquisites. 17.3 is profits in lieu of salary. So now we are going to understand this salary component. So salary includes 4 components. So wages, salary, bonus, and allowance. So these 4 put together are called salary. So 17.1 talks about these 4 things. And what do you mean by allowance? Allowance might be fully taxable. Sometimes it might be partly taxable. Sometimes it might be fully exempt also. So salary as such will be taxable. Salary has 4 components: wages, salary, bonus, and allowance. In allowance, there are 3 components. Sometimes an allowance could be fully taxable. Sometimes an allowance could be partly taxable. Sometimes allowance could be fully exempt. So when you talk about partly taxable, there are examples like house rent allowance under 10 clause 13A and special allowance under section 10 clause 14. So these are the things that we are going to discuss. We'll also see what is fully exempt and what is fully taxable. So we'll see this. So when you say fully exempt, These are the things that are fully exempt. What are these? Allowances to High Court judges, allowances to High Court judges, allowances paid by the UNO, compensatory allowances received by the judge, sumptuary allowances granted to High Court or Supreme Court. So these are all called as exempt allowance. So all these allowances are fully exempt, including any allowance or perquisite granted to government employees outside India. So this is also exempt. And any allowances paid to Union Public Service Commission chairman. So the rent, the conveyance, the sumptuary allowance, and the leave travel concession, everything, all of this is basically what? Basically not covered, for taxation. So this is what is called fully exempt. Now this fully exempt is not applicable in new tax regime. So when you say fully exempt, it is not applicable. It is not applicable in new tax regime. So these exempt allowance is only available for old tax regime. It is not available for new tax regime. And what about fully taxable allowance? The ones that are listed here are called fully taxable allowance. Your entertainment allowance, DNS allowance, overtime, fixed, on all these allowances. I need not read out through, you yourself can read it through. So all these allowances listed here are called fully taxable. One thing that you have to keep in remembrance is transport allowance. When you say transport allowances, there are three types of transport allowance in income tax. First transport allowance is for official duties. Second transport allowance is for commuting between home and office. So வீட்ல இருந்து office for a distance. So for this distance, if I'm commuting, whatever is the transport allowance is basically is not considered. That is, it is called as a transport allowance. That is fully taxable. Such allowance could also be given to persons who are differently able. So for persons who are differently able, for them there is exemption. So what is fully taxable? Transport allowance given to persons other than differently able. So and anything else, any other name, what could be covered will be covered as fully taxable. So these are all the incomes that are basically taxed as fully taxable allowance for the purpose of income tax. Moving on, we'll understand about certain allowances that are fully taxable. There are three things that we saw in the previous slide: entertainment allowance, city compensator, and transport allowance. So when you say entertainment allowances, it's for any additional benefits for the purpose of customers or employees or whatever. Now, entertainment allowance is fully taxable for private employees, but government employees have deductions. Government employee will have some deductions from this entertainment allowance. They'll get exemption they'll claim deduction under section 16. So section 16 will give some of the deductions for government employees with respect to entertainment allowance. When you're a private employee, no, nothing. It is fully taxable. Whatever you're receiving as entertainment allowance is straight away taxable. Next one is city compensatory. It is exclusively for compensating for high cost living. For example, I'm a native from Madurai, I'm settling in Chennai. Chennai is as a high cost of living. So to compensate me for that high cost of living, if I'm receiving some of any other allowances, that is also fully taxable. And finally, transport allowance, as I told you, for commuting between office and home. It is fully taxable. But if it is for differently able, blind, deaf, orthopedically handicapped. So if blind, deaf, and orthopedically handicapped, so for them it is exempt up to 3,200 per month. So which is roughly around what? 43,200 in a year. 3,200 per month. Per month is what is eligible as a deduction for as transport allowance for differently abled people. When you say differently abled, they are blind, deaf, or orthopedically handicapped. So for these people, it is completely taxable. Your transport allowance is fully taxable. So these are all the allowances that are fully taxable. We will now understand about salary. So when you say HRA, house rent allowance. So it is discussed under section 10, clause 13A. Section 10, clause 13A. So what do you mean by 10, clause 13A? It talks about how much of house rent allowance is exempt. Section 10 is typically a section which talks about exempt income. So all the sections in section 10, all the clauses in section 10 talks about exempt income. So in that clause 13A It's like Padimuna number veedu. It's like a ghost house, right? So 13A. 13A talks about house rent allowance. So now you are eligible for house rent allowances depending upon certain formula, certain restrictions. So it is not fully exempt. It is partially exempt, partially taxable. Before we get into this, we need to understand a particular concept of salary. For the purpose of this section, for this allowance, salary refer to basic salary plus dearness allowance forming part of retirement benefit, dearness allowance forming part of retirement entitlement. So dearness allowance, retirement entitlement. So if it is belonging to that, that must be included. And commission as a fixed percentage of turnover. So there is a turnover, on that you are charging a commission. Percentage of turnover. So that is what is called as fixed percentage of on turnover. So this is also included. So these three to put together is only salary for the purpose of house rent allowances. Why should I calculate this? I should calculate this because only based on this, I will know how much is exempt. So to know the exemption, I'm going to tell you that you have to remember certain things that is called as A, what is the actual HRA, what is the actual rent, and what is the apportion. So basically the first part of it is called actual HRA, which is HRA actually received. So whatever you have received is the first component. The second component is called rent paid minus 10% of the salary. So this is like a proportion. So you calculate based on the actual rent paid. So rent paid minus 10% of salary. So what do you mean by salary? Salary refers to basic, dearness allowance forming part of retirement entitlement, and then commission as a percentage of fixed turnover. So that is your second component. What is the third component? Third component is something like a limit. So limit is, if you are in metro, it is 50% of salary. If you are in non-metros, then 40% of salary. What do you mean by metro? Delhi, Mumbai, Kolkata, and Chennai. Delhi, Mumbai, Kolkata, and Chennai. So these are the 4 cities which are covered. Even cities like Bangalore, Hyderabad are all not covered. And of course, it is not for own house. So you cannot pay for your own house. And when you say relevant period, it is for the period that you have taken. So if you're, when you say relevant period, if you have rented it for 6 months alone, you have to calculate these two things, this and this, only for 2 months. So this actual rent and apportion should be for the relevant period. So which means if you are rented for 6 months, you have to calculate only for 6 months. If you have rented for 9 months, you have to calculate this for 9 months. And this is also not available in new tax regime. So this is also not available in new tax regime. So you cannot claim this in new tax regime. So these are all called as your house rent allowances. So as I told you, it is not available for new tax regime. So there is no exemption on new tax regime. Okay. Apart from this house rent allowance, the next allowance we'll be seeing about is section 10, clause 14, 10 clause 14. So what is special allowance typically? When you say clause 14, we all know what February 14 is. We all know what February 14. It's for special people like Valentine's Day. It's for special people. So here section 10 clause 14 is for special allowance. It's a special. They're giving you special allowances. They're treating you in a special manner. So it's similar to your February 14. So it's a special allowance given for special people. So that is 10 clause 14. So there are 2 components to this. The first component is called office expense. That is, which means allowance given for meeting out office expenditure. There is no limit. It is fully exempt. The second category is, it is not for office expense. It's not for office expense. So we can understand that it is for personal expense. So here there are limits. The limit which is applicable as taxable or not taxable. So we are going to understand what is office expense. Office expense, something which is not in the nature of perquisite. What do you mean by perquisites? Something like additional benefits, right? Car, accommodations, medical facility, education facility, loan facilities. So these are all given to an employee. This is also special, but this is discussed separately as perquisites. So when you say perquisites, when something is covered as perquisites, it is not covered under special allowance. So this is what you're calling it as not being in the nature of perquisite, and it should be specifically granted to meet the expenses that is wholly, necessarily, and exclusively for performing the office duty. So this is what you're actually calling it as not being in the nature of perquisite, specifically granted. There is no limit. But to the extent it is received from the employer. For example, I've spent 6,000. I've spent 6,000. My employer has given me 4,000. 4,000 is exempt. 4,000 is exempt. So only to the extent you are receiving from the employer is exempt. So there is no limit, but whatever is utilized for the purpose is exempt. So whatever you have received, if you have received 4,000, if you have spent 6,000, 6,000 is not exempt, 4,000 is only exempt. But if you have spent only 3,000, 3,000 is only exempt. So to the extent you have spent, to the extent you have received. So this only is basically considered as office expense that is not taxable. That is not taxable. Next component is personal expense. Personal expense. So of course we said it is taxable, partially taxable, partially exempt. So it is to meet their personal expense. So basically to support the staff, to support the employee for various reasons. So we'll see whatever is important for the examination alone out of the special allowances. We'll first understand the office expense. So when you say office expense, there are six categories of office expenses. First one is traveling allowance, daily allowance, conveyance allowance. The last three is helper allowance, uniform allowance, and research allowance. So these 6 allowances are called office allowances. So when you say office allowances, these 6 expenditure are covered as office expenses, which means there is no limit. Whatever is paid is basically tax-free. It is not taxable. So, but we have to understand what exactly it is. When you say traveling allowances, it is not between commuting to office and home. It is not about commuting office and home. It is about travel on tour. If my client stays in Madurai, I'm traveling from Chennai to Madurai. So this travel is office travel. So whatever I'm spending here is for office purposes. So I get it back from the employer. It is not taxable. It is not taxable. So that is what you call cost of travel on tour or transfer. It also includes packing and transportation of personal effects. So I'm transferring from Chennai to Mumbai. Whatever I'm shifting, the packing charges, the transportation charges between Chennai to Mumbai, if my employer is giving me, it is not taxable. If my employer is giving me, it is not taxable. And what about daily allowance? What about daily allowance? Daily allowance is like for meeting your day-to-day expenses when you are in a different place of working. For example, let's take marketing executive. When they're traveling outside their place, if they're given something, it's called daily charges. And that, since it is given to meet out the expenditures of office related stay and other things, it is not covered. So that is also exempt. And what about conveyance allowance? For performance of office duty within Chennai, I'm traveling to different places. Conveyance, Ola, Uber, or whatever charges is basically covered. Reimbursed is not taxable. The next 3 is helper, research, and uniform. This is not available for new tax regime. It is not available for new tax regime. It is only available for the old tax regime. So the 115 BAC, you cannot choose this. What cannot you choose? You cannot choose helper, research, and uniform. What is helper? You are giving a support staff. What is research? You're doing some R&D activity for the company. They are giving you, it is not allowed. And similarly, uniform allowance. Uniform allowances is for purchase and maintenance of uniform. So these three are not allowed under the new tax regime. So now we'll move on to the important clauses of personal allowances. Personal allowance out of special allowance. What we discussed in the previous slide is office expenses. Now what we are going to discuss is about personal expenses. When for personal expenses, we said there will be a limit. Whatever I'm going to cover is only important, and there are around 15-20 special allowances for personal. Whatever I'm covering is only relevant what is relevant for an examination. So don't ask me if I've left out something. Yes, I have left out. So we are going to only discuss about these 4. So basically the first one we are going to talk about is employee of a transport system. So roadway or whatever, that particular company which is into roadway transport system as an employee, for that employee they are giving such allowances. Why do they give? They're of course not with the family. They've been traveling one place to another. So for this allowance, 70% of such allowance or maximum of 10,000 per month is exempt. It's not taxable. So out of your total allowances, 70% of such allowances subject to maximum of 10,000 per month will not be done. So if my total allowance is 14,000, 70% will be 9,800. So which means 9,800 is exempt. In case if it is 15,000, 70% will be 10,500. So how much is exempt in that case? 10,000. So maximum of 10,000, but 70% is allowed. So that's what you're saying. And about children education allowance, you all will know it by heart, 100 per child and for 2 children. So that is what is there. Hostel expenditure, 300 per month, maximum of 2 children. Whenever I read this, I always get a doubt, how can someone have an education rupees per month? It's definitely not possible. So these limits are all what kept in 1960s. It was not revised later on. So I'm sure that you all will agree that both these expenses are nowhere close to reality, but that is what it is. So what is your provision? 100 per month for 2 children, 300 per month for 2 children. So that is education and hostel. So there is no confusion about it. So you need not think why it is low and all. As far as your examination is concerned, you are supposed to write whatever is given here. And with respect to transport allowance, we are seeing a lot of transports, right? So this transport allowances, we already discussed. It is for commuting between office and home. If it is for differently abled person, 3,200 per month is exempt, Anything above that will become taxable. For example, if someone is receiving 4,000 and they are blind, 3,200 is exempt, 800 is taxable. So 800 into 12, 9,600 will be taxable. So this is what you are calling it as 3,200 per month. Anything excess is taxable. Please remember, this is applicable for new tax regime. It is not D, it is new tax regime. So what do you mean by this? Rest of these provisions, that is 4th, 5th and 6th provision is not applicable for new tax regime. So when it comes to new tax regime, this is not applicable. So these three, your transport allowance for employee in transport system, education allowance, hostel expenditure, these three expenditure are not considered for new tax regime. Only this transport allowance for blind or deaf or orthopedically handicapped, only that is allowed for new tax regime. So please be clear in that concept. We will move on to the next provision. We will move on to the concept of annuity and pension. Both are more or less same. You probably will be rarely tested on this concept of annuity. So annuity is also salary. One thing that you have to keep in mind is who's giving you the annuity. Annuity is like an insurance policy. I put money into a policy. Either I put or my employer puts or whatever. In future, when I'm retiring, I'll start getting money from that policy. So this is what annuity is about. So if I'm receiving annuity from the present employer, it will be considered under the salary. If it is received from the past employer also, it is still salary only, but it will be considered as profits in lieu of salary. That is 17.3. So this will be discussed in 17.3, profits in lieu of salary. If it is received from anyone else other than the employer, then automatically it will be covered under income from other sources. It will be covered under income from other sources. So this annuity is divided into 3 categories: present employer, past employer. Both are salaries. Anyone else, it is covered under income from other sources. So what is pension? Pension is also a similar thing, just that it will be directly paid by the government. It will be directly paid by the government or the relevant employer. So there is no anyone else. So this person will be paying only after retirement. So after retirement, they will be paid. So there are 2 components of pension. One is called uncommuted. Another is called commuted. When you say uncommuted, it's a periodical payment, monthly payment. This monthly payment is taxable to all employees. It is taxable to all employees. But whereas when it is commuted, it is only taxable for, it is partially exempt for both of them. Partially exempt is for both of them, whole or part. It is partially exempt when it comes to your non-government employees. For government employee, it is fully exempt. We'll see that. So currently, what should you understand? You should understand 2 things. Pension is divided into uncommuted and commuted. Uncommuted means monthly payments, which is taxable for all employees. Commuted means lump sum payment. Part is exempt, part is taxable. So depending on the situation, depending upon the nature, it is partially exempt or partially taxable. So for whom it is partially taxable, for whom it is partially exempt, how do I calculate? All that is what we are going to understand now. So when I say uncommuted, I said it is fully taxable. Uncommuted is fully taxable. So if question says 6,000 was received for 5 months, 6,000 into 5, 30,000 is fully taxable. No doubt about it. Government employee, non-government employee, whoever it is. But if it is commuted pension, for some of the category it is exempt. For some of the category it is partially exempt. So we are talking about a situation where it is specified employee and it is fully exempt. It is fully exempt. That is 100% exempt. Who are these people? Central government employee, local authority, statutory, member of civil services, defense services, judge, annuity plan of LIC. In these situation, your pension, your commuted pension is exempt. In other two situations, it is partially exempt. The first situation is if you are also in receipt of gratuity, 1/3 would have been received had he commuted the whole. 1/3, which means, what do I mean by 1/3 had I commuted the whole? For example, if I'm receiving 6 lakhs, which is like 50%. So 6 lakh is 50%. So now what do? I first convert this 50% into full amount. So if 6 lakh is for 50%, how much is it for 100%? So 6 divided by 50%. That is why I said commuted pension divided by commutation. How much is commuted pension here? 6. How much is commutation here? 50%. So 6 divided by 50% into 100%. That will give me what? 12 lakhs. That will give me 12 lakhs. So now automatically what is happening? Out of the 6 lakh, 1/3 out of the 6 lakh, 1/3 is exempt out of this 12 lakhs, not 6 lakhs, 12 lakhs. So 6 lakh is the pension I received. I'm converting that into full pension. So 6 lakh divided by 50% into 100, that will give me 12 lakhs. So in that 12 lakhs, 1/3, that is 4 lakhs, 1/3, 4 lakhs is exempt. So which means out of 6 lakh, 4 lakh is exempt, balance 2 lakh is taxable. So that is why you call it as 1/3 of commuted pension, add if the whole amount has been commuted. So I convert the received commuted into whole commutation divided by 3. So that is why I said it is the formula. And what if you have not receiving gratuity? Please remember the word is receipt. Word is receipt. I'll tell you the importance. So the word is receipt. I'll tell you the importance of why I'm stressing this. So if you are not receiving gratuity, the 1/3 will become 1/2. So in the same example, if this is 6 and this is 50%, what will be the number? You will get 50%. 6 by 50% is again 12. So 1/2 of 12 is 6. So out of 6 lakhs, 6 lakhs is exempt. Out of 6 lakhs, 6 lakh is exempt. So partially taxable, partially exempt. So you have to calculate by determining this proportion. So for persons who have received gratuity, it is 1/3. For persons who have not received gratuity, it is 1/2. 1/3 of what? 1/2 of what? Commuted pension as if it is whole. So whole commuted pension. So that is what we have to understand one thing. Apart from this, other pension that are exempt is pension by the recipient of gallantry awards. So Paramveer Chakra, Padma Vibhushan, Padma Bhushan. So all these gallantry awards. So winners of this, either the self or the family members. If the self is no more available, so he is no more alive. So in that case, whatever pension is received by the applicant or the family member will be completely exempt. So section 10, clause 18 provides this. Pension on account of body disability of armed person invalidated. So you're an army, during army, Vijay will enter into a place where everyone will be either handicapped in some way or other. So what happens? Such persons have lost their hand or leg during army process. So that is called during the work. If they have been disabled, whatever they have given will be available as exempt. The pension, whatever they are receiving during this period, is basically exempt under the income tax act. This is through a circular given in 2019. So these are all what is called pension. That is called as, some it is exempt, for some it is partially exempt and partially taxable. And when you say for some, there is a different number for receipt of gratuity, different number for who have not received gratuity, 1/3 and 1/2. So you have to work this to understand. The component. So now the next thing that we'll understand is gratuity. So what do you mean by gratuity? Of course, it's like a gratitude. You're giving, employer is giving a gift to the employee. So that is like a contributing him for thanking him for working for such a long period. Generally, it used to be 5 years. So in this situation, the tax scenario could be 3. It could be fully exempt, fully taxable, or partly taxable. When you say fully taxable, If you're receiving during employment, it is fully taxable. When is it fully exempt? It is received either on retirement or death cum retirement. Death cum retirement. So for members of defense service, members of central government, members of civil service, and members of local authority. So these four situations, retirement or death cum retirement. So it is fully exempt, 100% exempt. Whereas when it comes to during employment, it is fully taxable. So this is what we need to understand as far as the taxability is concerned. In some situation, it is partly taxable. In some situation, it is partly taxable. In what situation? We will understand these provisional formulas using three components called as ALP. So ALP, A stands for actuals, L stands for a limit, P stands for a proportion. So this ALP is what we are going to understand most of the provisions. So as far as gratuity is concerned, we are going to divide. When say partly taxable, we are dividing into two type of people, two sets of people. One set of people who are covered under Gratuity Act, another set of people who was not covered under Gratuity Act. That's why I said the word receipt is important. What did it say in pension? It said receipt of pension, receipt of gratuity. If you have received gratuity, it is 1/3. If you have not received gratuity, it is 1/2. So there the word was receipt. Here it is covered under Gratuity Act. So it's not about receipt. If you are covered under Gratuity Act, the ALP, A stands for gratuity receipt, L stands for 20 lakhs. The limit is 20 lakhs. And proportion is 15 by 26. 15 by 26 into last drawn salary into service period. So 15 by 26, last drawn salary, service period. So why 15 by 26? Typically a month will have 4 Sundays. So working days could be 26 days. So Saturday is also working in most of the factories and other things. Saturdays will be working, manufacturing will be happening. So the working days will be 26. So when you say 26, 26 is a month. So we are taking half month, that is 15 by 26. We are not taking 13, 15 by 26. So half month is 15 days. Number of working days is 26. So 15 by 26 into last drawn salary, What do you mean by last drawn salary? In the month of quitting this organization, whatever I've drawn, that is what is applicable. And what do you mean by the term salary? It includes basic plus dearness allowance. So here dearness allowance does not talk about retirement benefit. Dearness allowance does not talk about retirement benefit. It only says dearness allowance. So basic plus dearness allowance is included. And service period is rounded off. What do you mean by that? If it is 6 months or more, it is converted into 1. For example, if it is 26 years, 7 months, it will become 27 years. 26 years, 5 months. 26 years, 5 months, it will become 26. So it is rounded off. So if it is more than 6 or more, it will be automatically rounded off to the next number. Whereas in not covered, the A is the same, L is the same, P alone goes for 1/2 into 10-month average salary and completed service period. So these three things. Instead of 15 by 26, it is 1/2. That is exactly half. Whatever you're receiving, you divide it by half. You are not taking working days and all. It is divided by 2. And instead of last drawn salary, you are taking 10-month average salary. So for the last 10 months, you calculate what the salary is divided by 10. Why take 10 months? Because you might have had appraisal, increment. So some changes would have happened to your salary. So instead of taking 1 month, you're taking an average of 10 months salary. So what do you mean by salary? There, that is when covered under Gratuity Act, it is basic plus dearness allowance. Here, when it is not covered, it is similar to HRA. What is it? Basic plus dearness allowance forming part of retirement benefit, commission as a fixed percentage of turnover. So these three things put together, exactly similar to your HRA. Into completed service period. So irrespective of whether it is 26 years, 7 months or 5 months, what number you take? You take 26. So 26. So you have to ignore the months. You have to take only the completed service period. So this is the difference between covered and not covered. What is different? Covered as 15 by 26 into last drawn salary, whereas it is basic plus dearness allowance. and service period that is rounded off. Whereas when you talk about not covered under Gratuity Act, A stands for gratuity received, L is same, but P alone, it is 1/2 into 10-month average salary into completed service period. So this is what makes your gratuity. Please remember, if you are receiving a gratuity, if it is received by the dependent person of the deceased employee, they also get this exemption. So not just for the employee alone, if the employee is no more, automatically the exemption will also be available for the dependent. So this is what gratuity is about. So next component, fees or commission. So this is also discussed in 17.1, but it will also be separately discussed in perquisites and profits in lieu of salary also. So basically, what do you mean by commission? Let's say I'm an employee. My employer tells me this is your fixed fee, but depending upon the turnover that you're making, I'll give you a commission depending upon the volume or whatever it is. For example, let's take Swiggy or Zomato or something. Their commission is based on their bonus or incentive is based on number of deliveries made in the day. So similarly, commission is nothing but extra reward for doing something. So this, whatever is received by the employee is fully taxable. And it could be as a fixed percentage of turnover or as a flat fee. Monthly 5,000 commission could also be there. Annually, whatever turnover you have achieved, I will apply 1%. So this could also be there. So it could be anything, but whatever name it is, fees, commission, etc., is basically taxable. It is taxable under the Income Tax Act as salary. The next component we are going to understand is leave salary or leave encashment. We all know what this means. So leave salary could be between government employee and non-government employee. For government employee, it is received at the time of retirement, is fully exempt. So if you actually look at it, there are a lot of benefits for government employee, right? So most of them are exempt, such things. So, but if it's a non-government employee, people like us needs to face this. What should you face? It is partially taxable, partially exempt. So what do you mean by this? How to calculate? As we already know, like any other provisions, what is it? Least of the following. Least of what? Here also we'll remember ALP. A is actual. So whatever you have actually received is number 1. Next is limit. Limit is currently increased to 25 lakhs. It is only increased in May 2023. So for your examination, it is 3 lakhs. For your examination, it is 3 lakhs. So it is not 25 lakhs. Only for next time, it is 25 lakhs. So currently it is 3 lakhs. So 3 lakh is the limit for your examination. So the limit is 3 lakhs. What about proportion P? P will have to calculate it for P1 and P2. So there are 2 proportions that you need to calculate. First proportion is 10-month average salary. So add as it is. So 24th May 2023. So the revised limit is 25 lakhs, not 3 lakhs. It is not 3 lakhs, it is 25 lakhs. So what is available for you is 25 lakhs. So for your examination also, it's 25 lakhs only. It's not 3 lakhs. Earlier it was 3 lakhs. Now it is 25 lakhs. So which means it's an amendment. So 3 lakh has now become 25 lakhs, which means it's critical. Why critical? Any amendment is critical for examination. There is an added weightage to any amendment. So this is an amendment. Till May 2023, it was 3 lakhs. From 24th May 2023. So that is from your examination alone. From November 23 examination, the revised limit for leave encashment will be 25 lakhs. So please remember, you will be very much tested on this question, on this provision. There is a high possibility. So what is this? A, I said actual received. L, I said it's a limit. It is 25 lakhs. It's not 3 lakhs. It has been upgraded to 25 lakhs. Your study material will have 3 lakhs. But if you go to that updates provided by the your institute, it will automatically be 25 lakhs. And then P1 is 10 into 10-month average salary, which is nothing but your 10-month salary. So whatever you're discussing is only 10-month average salary. And then P2 is a calculation. You're going to calculate cash equivalent. You're going to calculate cash equivalent of the salary. So how do you calculate this? First, you're going to calculate step 1. Step 1, you're going to calculate eligible leave. Step 1, you're going to calculate eligible leave. So what is eligible leave? 30 days. 30 days into service period. So when you say service period, completed years. So it's not rounding off. So what do you mean by service period? If I've worked for 26 years, 8 months, I only take 26. So 26 into 30, 26 into 30, that will be my step 1. Leave credit. Out of this eligible leave, that is 30 into 26. So 30 into 26, that number of days I can take. But how many days I'm actually taking? I've only taken leave availed. So how many days I've actually taken? So eligible leave minus leave availed. Eligible leave minus leave availed. This will automatically become my leave credit. From this leave credit, just give me a minute. So yeah, sorry. So from this date, so you have calculated eligible leave, you have calculated leave credit, you have calculated eligible leave, you have calculated leave credit. So in this leave credit, what do you mean by leave credit? Eligible leave. So in example, we took 26 years. So 26 into 30. 26 into 30. So which be 780 minus the number of days I've taken. The number of days I've actually taken. So this will become my whatever leave credit will become my balance leave that I have not utilized. Leave that I have not utilized. It's nothing but unutilized leave. Unutilized leave basis on 30 days per year. Basis on 30 days per year. Company might tell you are eligible for 60 days leave, 40 days leave, 50 days leave, whatever it is. But eligible leave is basically 30 days a month. 30 days a month is what you're eligible minus leave available. Now, cash equivalent. This leave credit is divided by 30. Why am I dividing by 30? I'm converting this into months. So leave credit divided by 30. What is the purpose? I'm converting this into months. Most of the Income Tax Act, if you know the purpose, you need not remember the provision as it is. You can just remember it as it is. So now I add eligible leave, that is 30 days in a year. I calculated eligible leave minus leave availed. So what is leave availed? Number of days I've already taken. For example, now I've taken 200 days. So I need to minus 200. I need to minus 200 from 26 into 30. So 26 into 30, let's say 780. 780 minus 200 is 580. Out of 580 is days. So I'm converting that into month. I'm converting it by dividing it by 30. I'm converting it by dividing it by 30. Now I get months. Leave credit in months. I have the leave credit in months. Now this is multiplied by 10-month average salary. So whatever you have calculated here, 10-month average salary. So I take the 10-month average salary, this part alone, 10-month average salary. I divide it by that. I multiply by cash equivalent. Now I get a number. That is P2. What is P1? Standard 10 months salary. 10 months salary. Standard 10 months salary. So this is what is the maximum available. So P2 is this proportion. So I take eligible leave, then I calculate leave credit, then I take cash equivalent. So these 4 items, that is AL, P1, P2, whichever is least is what is given as a thing. Both in the previous provision, that is gratuity and leave salary, both in the provision of leave salary and gratuity, there is a word which talks about, we said it's for life. So whatever we calculated, we said it is for life. So we said it is for life. So in gratuity also we saw this word, it is for life, which means in subsequent years, if you have already received it earlier, you need to reduce it. For 5 years back, I have received leave encashment and I have taken exemption. I need to adjust that now. So basically this leave encashment limit or the gratuity limit is all for life. So 20 lakhs there or 25 lakhs here, it is for life. And during service is fully taxable. And what is salary? Basic plus dearness allowance forming part of retirement benefit and fixed percentage of commission. And what do you mean by 10-month salary? 10 month immediately preceding the date of retirement. So if I'm retiring today, minus 10 months. Minus 10 months is what I need to take for my salary calculation. So this salary divided by 10. 10 months salary divided by 10 will give me monthly average salary. So that is what you're actually calculating it as. The proportion, the salary for the purpose of leave encashment. So by applying these, you will calculate leave encashment. So next is provident fund. So next provision that we'll be understanding is provident fund. So provident fund, we all know it is a benefit given to an employee. There are two types of contribution. One will be employer contribution, another will be employee contribution. And when you say contribution, whatever goes into account is like namaloda savings bank account mari. I will contribute. Company, the bank will give me interest. So here, employer will contribute, employee will contribute. Both the fund will go into that account, and that account will give me interest. So there will be two components in my account. One will be contribution, another will be interest. And whatever is paid during retirement or death. So it could be paid either at the time of retirement or at the death. So this is what is called as PF. So basically PF is divided into 4 types of provident fund. So first is called recognized provident fund. Second is called unrecognized provident fund. Third is called statutory provident fund. Fourth is called public provident fund. So what is recognized provident fund? Recognized provident fund, which is recognized as a provident fund by the income tax, So this is basically governed under Employee Provident Fund Act. EPFO அப்படின்னு சொல்லி பார்த்திருப்பீங்க. So that is your Employee Provident Fund Organization. So this is governed, this is approved by the income tax also. So this will have its own rules, recognition, everything. So that whatever comes under that is called recognized provident fund. Unrecognized, of course, which is not being recognized, is called unrecognized. Idu thavara, there are 2 more: statutory provident fund and public provident fund. So basically, when you say statutory provident fund, the government, the railways, the semi-government, so all these statutory bodies will have its own provident fund, they may have their own provident fund. So that is called statutory provident fund. So government employees and educational institution contributing into a fund will be called statutory provident fund. What about public provident fund? The last one is public provident fund. When you're an employee, employee contributes PF, employer also contributes PF. Employee contributes PF, employer also contributes PF. But what if you are not employee, but you still want PF? What if you are not an employee, but you still want PF? You still have something called public provident fund. So every bank will have this account. You can maintain. It is ideally for self-employed. It is maintained in the bank. It's like a normal account maintained in the bank. You can keep putting money into that account. Whatever interest accrues, that will be covered separately. So now types of PF is these 3 types, these 4 types. Now we'll see about the taxability. Eppa taxable illan paapom. So first we will understand about during employment. What if I'm receiving PF? That is the contribution. As an employee, I will contribute. Employer also contribute. So we'll talk about during employment. There will be contribution, there will be interest. So there will be 2 elements. One will be contribution, another will be the interest. Employer will contribute, employee will also contribute. Interest will be there. Interest will be there on employer contribution. Interest will be there on employee contribution. Apo, what is the provision as such is employer contribution, excess of 12% of salary is taxable. In recognized provident fund, RPF, whatever contribution is made in excess of 12% of salary. What do you mean by salary? நம்ம HRA பார்த்தது, நம்ம not covered for gratuity பார்த்தது. What we saw in leave encashment, what did we see? Basic salary plus dearness allowance for the retirement entitlement and fixed commission as a percentage of turnover. So all these is what you're covering it as the salary component. So 12% of these 3 components, 12% of these 3 components is only called as taxable. So excess of 12% of these 3 contribution becomes taxable. Adhe statutory provident fund, no limit, fully exempt. PPF employer cannot contribute because employer contribute panna, it is not PPF, it is other 3. So URPF it is not taxable. Whatever is given by the employer is basically not taxable irrespective of the limit. Now what about the employee contribution? Employee contribute pandrathu, it is eligible as deduction under section 80C for both RPF SPF, PPF. இது மூணுலயுமே whatever has been contributed in all these three, whatever has been contributed is eligible as a deduction under section 80C. Eligible as a deduction under section 80C. But if it is unrecognized provident fund, it is not eligible, which means there is no deduction for URPF. So this is about the contribution made. What about the interest? RPF, whatever interest you receive is exempt up to 9.5%. So if your interest rate of RPF is less than 9.5%, the entire amount is taxable. If it is above 9.5%, that excess becomes taxable. So first 9.5% is exempt. In addition to 9.5% is taxable. SPF is fully exempt. PPF employer no one can contribute, and URPF it is not taxable at the time of credit. So whenever interest is accounted into that PF account, at that time it is not taxable, but it is taxable at some point in time later. So these are the situations, right? But if the employee contributing to these funds, that is employees contribution interest. First we saw contribution alone. Now we are seeing interest. In interest, we have already discussed contribution from employer. Now we are going to understand contribution from employee. That is interest on employees contribution. Interest on employees contribution. We'll understand that. So this was an amendment in Finance Act 2021. So get the 1 year amendment. So couple of years. So now what you are studying is Finance Act 2022. What we are saying is Finance Act 2021. So what they say is split the employee contribution. You split the employee contribution into two. So one is till March 2021. Another is from 1st April 2021. So financial year 2021 varakum till financial year 2021, whatever is interest is there, you can take it as it is. Now anything above, anything apart from this year 31st March 2021 will automatically be covered under the new provision. So old provision, new provision. So this is old. And this is the new provision. So whatever is deposited, whatever is contributed from 1st April 2021 will come as new provision. So this RPF, as we said, there are 4 funds. Yeah, it is RPF, SPF, PPF. URPF, we already said it is not taxable at the time of credit. Now, what about RPF? Any contribution through RPF is exempt up to 9.5%, correct? Any contribution into SPF and PPF is fully exempt. Simple. Okay. Simple. Whatever we saw for employer applies for RPF also. So whatever we saw for employer applies to employee also in case of in the 31st March 2021 varakum till 31st March 2021. What about subsequent period? We are saying from 1st April 2021. From 1st April 2021, you calculate in a different manner. Check whether employer contributes. If employer contributes, then follow this LO series. If employer does not contribute, follow the green series. So what is LO series? If employer contributes, contribution up to 2.5 lakhs, whatever is discussed above, that is 9.5% varakuna, it is not taxable. Above 9.5%, it is taxable in RPF. SPFO, PPFO are the fully exempt. This is when your contribution does not exceed 55 lakhs. So the contribution does not exceed, employees contribution does not exceed 2.5 lakhs. Now, what if it exceeds 2.5 lakhs? That proportion of interest, whatever exceeds 2.5 lakh, is completely taxable. Appa enoda contribution I'm splitting into 2 parts. Up to 2.5 lakh is part 1. Above 2.5 lakh is part 2. On this part 1, whatever interest I'm receiving, it is exempt up to 9.5%. Anything excess becomes taxable. In case where it is above 2.5 lakhs, please understand we are talking about the interest. Anything above 2.5 lakhs, the interest is அப்படியே taxable, that is 100% taxable. And what about when employer does not contribute? What happens when employer does not contribute? The limit goes to 5 lakhs. In the 2.5 and 5 lakhs, 2.5 lakhs represents your basic exemption limit. The tax rate or the first slab is 2.5 lakhs. What is the next slab? 5 lakhs. So if employer contributes, it is 2.5 lakhs. If employer does not contribute, it is 5 lakhs. So please remember the differentiation. Where do you remember this number? It is nothing but your tax slab. Employer contribute panna first slab 2.5. If employer does not contribute, next slab 5 lakhs. So that is what the limit. So and if it is up to 5 lakhs, this interest provision applicable. See where the line goes. But if it is more than 5 lakhs, it is 100% taxable. It is 100% taxable. So the entire interest in case of contribution in excess of 5 lakhs will be completely taxable. Other in the case in excess of 2.5 lakhs, it will be entirely taxable. So this is what is about PF is about. So we have understood about PF contribution, employer contribution, employee contribution. We also understood about the interest. Employer interest from employer contribution, interest from employee contribution, 4 funds: RPF, SPF, PPF, URPF. Now, with respect to provident fund, we discussed about the interest and other thing. During employment, what happens to the contribution, what happens to the interest, all that we are discussing. Now, what happens at the time of retirement or termination? What happens at the time of retirement or termination? If it is recognized provident fund, it is exempt under section 10 clause 12, exempt under section 10 clause 12. But what is the condition? It is exempt only when these conditions are satisfied. What is the condition? It must be continued service for at least 5 years with the employer. So continuous employment for 5 years with the employment. So if I'm resigning today, I should have been working from 2018 itself. Only then I'm in continuous employment. So continuous service for 5 years. Otherwise, I am taken out of the job because of ill health, contraction or discontinuation of employee's business, any other cause beyond the control of the employee. So which means all these 3 is not in my control. திடீர்னு எனக்கு heart attack இருக்குன்னா, is it in my control? Not in my control. Because of that, I am not able to work. That is also not in my control. So that is ill health. If the employer business is dropping, going down, and he is closing down his business, is it my problem? No. Because of his discontinuous, he is dropping me, he is stopping me. Same way, it could be any other reason also. So which means if it is not under the control of the employee, so that is ill health, contraction or discontinuation, and no beyond the control. So this 3 reasons, basically the service is terminated, that is also eligible. So this is also eligible. Last one, fully transferred to new employer. So I am quitting company A, joining company B. My provident fund in company A is transferring to company B, that is also covered. Similarly, national pension scheme, I'm converting from PF to pension scheme, national pension scheme. This transfer is also allowed. So in the mono situation, that is continuous period of 5 years, service terminated due to reasons beyond the control of the employee, and in any other situation, he is moving to a new employer or fund is being transferred to NPS or ATCCD. So இதெல்லாம் இருந்துச்சுன்னா the amount is exempt. So that is RPF. What about PPF and SPF? No questions, no queries, straight away exempt. So section 10 clause 11 says whatever you are receiving from public provident fund or statutory provident fund, whatever money you receive is fully exempt under section 10 clause 11. What about unrecognized? Employee's contribution is not taxable. Because employee receives salary. Employee, my salary is 1 lakh. Now I will receive salary. In 1 lakh, I will take 10,000 and put it into URPF. So which means when I'm receiving it as salary. I'm subsequently investing. So this is the contribution is not taxable. So contribution is not taxable because I am receiving the whole money and then putting some into the PF account. But the interest on such contribution is fully taxable under income from other sources. The interest on such contribution is fully taxable under income from all sources. And what about the employer's contribution? Whatever employer contributes, both interest and salary, interest is straight away taxable. Interest is, so contribution including interest, both the contribution and the interest is taxable under salary. So that is your provident fund at the time of retirement or termination. Provident fund at the time of retirement or termination. So next topic that we'll understand is 17.3. There are three sections, three clauses I told you, 17 clause 1, 17 clause 2, and 17 clause 3. 17 clause 1 is salary, 17 clause 2 is perquisites, 17 clause 3 is profits in lieu of salary. What we are going to discuss right now is profit in lieu of salary. Okay, 17 clause 3. There is something left out, right? 17 clause 2, perquisites. It's a very vast topic. So I thought I'll discuss it after this, after covering 17 clause 3. So what exactly is profit in lieu of salary? So profit in lieu of salary could be any of these. It is any compensation on account of termination of employment. An employer is terminated. So because of this termination, a money is being paid, even though it is current employer or former employer. So I could receive it at any point in time. At the time of receipt, it is taxable. So it is profits in lieu of salary, which means it is actually not salary, but it will be considered as salary. So it takes the characteristics of salary. Compensation on account of modifications of the terms and conditions of employment. For example, currently they have put me in statutory audit team. Okay, a company has put me in statutory audit team. So then suddenly, due to various reasons, the statutory audit team is going to be closed down. So they are changing the terms and conditions of my employment and saying that I will be involved in the treasury operations. I'll be involved in the treasury operations. So for this change, since they are forcefully moving me from the audit team to treasury team, they are telling me they'll give me 5 lakhs. They'll give me 5 lakhs. So now, since the money I'm receiving is because of the modifications of the terms and conditions, modifications of the terms and condition. So whatever I receive now will be taxable under salary. Not only what I received from my current employer, it could be from my former employer. Please remember, it is a capital receipt. This receipt is a capital receipt. Usually capital receipts are not taxable, but this receipt is taxable. So generally, what thumb rule for revenue receipt and capital receipt is revenue receipts are generally taxable unless provided in the Act. For example, section 10. These are revenue receipts, but not taxable. So revenue receipts are generally taxable unless provided in the Act. Capital receipt is ulta. Capital receipt is generally not taxable unless provided in the Act, like this account modifications of terms and conditions. And only thing is, it must be connected with the employment. The change should be connected with the employment. And any payment received from PF or other fund. So which means whatever was not discussed earlier, the RPF, SPF, PPF, URPF, அதில் discuss பண்ணாதது, what was not discussed there, if something is separately discussed, then it is covered here. So all these clauses, so for example, 13A is HRA, we saw about leave encashment. So all these things, 11, 12 is about PF. So all these things we discussed. இதில் இல்லாதது, if you are receiving anything separately, that is also covered. So any other payment apart from the contributions from these sections or clauses that we discussed. And next is key man insurance policy. What is key man insurance policy? Key man, so key managerial person. So any key managerial person, for example, or partnership firm, the most important people will be the partner. So their life could be insured, because if something happens to them, the firm will get affected. So any amount received from the insurance provider and including the bonus is basically taxable as profit in lieu of salary. So if an employee is receiving key man insurance policy amount from anyone, from the company or the insurance person, anyone. So whatever this employee is receiving as key man insurance amount is basically taxable. Finally, lump sum payment. It could be any lump sum payment. For example, salary, they tell you, I will pay salary only once in a year. Per year, I will pay you 25 lakhs. So even though it is lump sum, it becomes taxable. Same way, sometimes lump sum could be given before joining or after cessation. So before joining, for inviting you, for example, I'm a very valuable resource. Company, I'm working in company A, company B wants me. So they say that apart from your salary increment, I'll also give you 10 lakhs upfront. So that is also salary. So lump sum payment is also salary. There is no relaxation to this. So next profit in lieu of salary is voluntary retirement, VRS. So we would have seen generally in many movies, Father will come back to the home saying that to provide money to the son or to compensate for daughter's wedding, I have taken VRS. So what is VRS? You are retiring on fine day, but you are not reached the retirement age. The retirement age is 58 now. Let's say when you are 50 itself, you are saying I'm taking VRS. So VRS is basically a pre-retirement. So preliminary retirement. So munadiya I'm retiring. So at that time, they'll be paying me a lump sum payment. Since I'm retiring it yearly, they'll give me some lump sum payment. It is basically partially taxable. So which are the entities eligible? All these entities which are listed here, the public sector units or IIT or state government, central government, local authority. So all these listed here are eligible undertakings. How much is exempt? It would be exempt under section 10(10)(c), subject to the conditions provided in the next slide. And you are not eligible to claim any relief under section 89. So 89, I'll take you through in the last slide. It's basically relief provided for difference in tax timing. So I'm supposed to receive it this year, but I'm not receiving the money this year. I'm receiving it after 4 years. Upper there will be a tax timing difference. So we'll discuss that when you're seeing section 89. And VRS can be done only once. And what is the rule? Basically, we said ALPs on only. A is actual receipt of VRS. Limit is 5 lakhs. P1 is 3 months salary of completed service period. 3 months salary of completed service period. P2 is last drawn salary into balance month service. So balance months, let's say I need to work for 5 more years, it is 60 months. 5 more years, it is 60 months. So 3 months into completed service period, 3 months salary into completed service period. So thrice. So 1 month salary, I take 3 months salary, I multiply it into the completed service period. So and then last drawn salary. So in all these cases, salary represents salary plus dearness allowance forming part of retirement benefit plus fixed commission. Fixed commission is what is there. So this is what exemption is about. What are the basic guidelines for VRS? The person should have completed 10 years of service, should have completed 40 years, should have completed 40 years of age. So this is what you call it as, this is what basically you call it as voluntary scheme. So it's basically there is a limit. So there is a limit for what time, that is 10 years of work should be there, completed of 40 years should be there. And what about it? It is applicable to all employees except directors of a company or a cooperative society. So it is not applicable to directors. So it is applicable to employees other than directors. Most important condition is it must reduce, this VRS must result in overall reduction of employees, which means when I am retiring as VRS, I should not be replaced. So I should not be replaced. So in the year there are 15 people who are taking VRS now. The company's headcount must get reduced. It should not increase. So overall reduction should be there. So because ultimately the objective of VRS is moving out the old staff and managing with younger staff. So there must be an overall reduction and such vacancy must not be filled up. So if I'm an accounts manager, when I'm moving out, I should not be replaced with another accounts manager. And same way, I should not be appointed as a person. I should not be appointed from any other company belonging to the same management. But Tata Irkana, let's say I've been taken away from Tata Motors and have been appointed in Tata Steel. So Tata Motors and Tata Steel come under the same management. So that is not allowed. VRS from Tata Motors joining in Tata Steel, no VRS, no exemption. So exemption is available only when you are retired, you are not joining elsewhere, or you are joining in places which does not belong to the same management. So that is what is calling a guidelines is given. And what is exempt? Actual receipt 5 lakhs and then 3 months salary of completed service period, last drawn salary into balance month service. So in all these cases, salary represents basic pay plus dearness allowance plus fixed commission as a percentage of turnover. So that is your VRS. So now we are moving to the next part, major part in salary. So there will be a lot of things that needs to be covered under perquisites. So when you say perquisites, it's of course extra benefit given in the form of something that is non-monetary. So it could be car, it could be house, or it could be anything. So these are called perquisites. So it is basically covered under, if it is in the course of employment, it is covered under salary. If in the course of business, it is covered under PGBP. So perquisite could be during employment or during service, during business. So if it is business, it is business income. If it is salary, if it is during employment, it becomes salary income. So it depends upon who is receiving perquisite, it is determined. So now what we are going to see is only about what is discussed here. We are only bothered about what happens when it is covered under salary. So we all should remember perquisite sometimes could be cash or could be kind, which means it could be a reimbursement or it could be given something. For example, you could be given a car or you could be a house. It's a kind. You could be appointing an helper. I will be repaying for that helper. Then in that case, it becomes cash. So at the end of the day, it is some value. It could be cash or kind. And the reimbursement of expenses for official duties. Official duties is not perquisite. Official duty is covered under what section? Section 10, clause what? Special allowance, what clause? Section 10, clause 14. So clause 14 is for special people. So like 14th February. So it's special allowance. Legal origin does not include unauthorized advantage taken by the employee. What do you mean by that? For example, if I'm eligible for a discount in a particular restaurant, let's say a nearby restaurant, which is or ITC hotel, I am eligible for some discount in ITC hotels. Now, no one is giving me, the company is not giving me the authorization, but I'm going and misrepresenting and claiming that benefit. Then that is not perquisite. Perquisite is what? Given by the employer voluntarily. He says, use my car, use my house. So that is only perquisite, not taking any advantage. So what about the taxability of perquisite? Some perquisites are taxable for all employees. Some perquisites are tax-free for all employees. And some are taxable only for specified employees. So in both these cases, it is all employees. In some cases, it is only taxable for specified employee and it's not taxable for non-specified employee. So of course, what I should know? I should know who is a specified employee. So these three is what we are going to understand. So of course, perquisites, we'll understand what are all the types of perquisites could be there. These are the items of perquisites, which are taxable for all, First is rent-free accommodation. Rent-free accommodation, other than those provided to the High Court and Judge Court, High Court and Supreme Court Judge. And next is rent-free accommodation only, but it is provided at a concession. It is not fully free. There is a concession. Next is there is an obligation of an employee. Employee is appointing an helper. Helper are appointed by the employee, paid by the employer. So it is first employee appoints an helper and pays them, and then subsequently employer reimburses. That is applicable for taxable for all employees. Payable by an employer directly or indirectly to effect an assurance on the life of assessee. Group annuity, fidelity insurance. So that is what is there. And it is not applicable on longevity benefits. For example, it is not applicable for medical insurance. So group annuity, fidelity insurance, for all this is covered as perquisites, but it is not covered for longevity benefits, which means anything that is for health. So anything that is for health is not covered here. So I'll stop with this HA alone because it's taking a lot of time for me to write. So this health insurance alone is not covered. Rest of the insurance is basically covered. Group annuity, ESA and fidelity insurance. So any contributions to that is basically a perquisite, provided it is not related to health. Next, equity shares, specified equity share or sweat equity shares is basically called as ESOP. So ESOP is also perquisite. So ESOP is also perquisite, which is also taxable for all. Last two is an amendment in Finance Act 2021. So basically employer contribution in excess of 7.5 lakhs. Employers contributions to PF or RPF, that is Recognized Provident Fund, NPS is National Pension Scheme, SAF is Superannuation Fund, approved Superannuation Fund. So in these funds, if the contribution is in excess of 7.5 lakhs, then it is automatically applicable as taxation. So upon amount of any employer contribution in excess of how much? 7,50,000. It's a recent amendment in Finance Act 2021. Not only the contribution, also any accretion, any other accretion on contribution exceeding 7.5 lakhs, which means interest on contribution exceeding 7.5 lakh also is taxable. Please remember, earlier in PF, We said employee contribution, interest on employee contribution in excess of 2.5 lakhs is fully taxable. Where employer contributes, employee contribution in excess of 5 lakhs, is entirely taxable. The interest portion of it. Here, what are we saying? Contribution in excess of 7.5 also is taxable. Interest on such excess contribution above 7.5 lakhs is also taxable. So this is what is covered as taxable for all. There are also other fringe benefits that are applicable. So these are the other benefits which are taxable for all. Interest-free loan, traveling, free or non-alcoholic beverage, so food, gift voucher, credit card expense, club expenditure, use of movable asset, transfer of immovable asset, any other benefit or amenity. So all this is covered as other fringe benefits. So fringe benefits is the cringe mari. Just because they are close to you, the employer is close to you, they are giving some extra benefit. So it's like cringe in your social media. It's fringe benefit. So it is for some extra importance given specifically to you. So now we said certain things are taxable for all. We saw, of course, what it is. In that we said PF is basically taxable at a particular thing. So there are two components to that PF. That is RPF, superannuation fund, and your national pension scheme. What we said was, we said contribution in excess of 7.5 lakh is taxable. First point, contribution in excess of 7.5 lakh is taxable. Next point, not only the contribution, any accretion. What do you mean by the word accretion? Addition. Other than style accretion. Any addition to that 7.5 lakhs. Any addition to that 7.5 lakhs is also applicable. Any addition to that 7.5 lakhs is also taxable. So now how do you quantify how much is towards that excess of 7.5 lakhs? Because it's a year on year, year 1 8 lakhs, year 2 9 lakhs. Year on year I'm contributing more than 7.5 lakhs. So how do I pick that accretion? The accretion could be in the nature of interest, could be in the nature of dividend or anything else. Now how do I calculate that? It's a very simple formula. When you actually look at it, it looks like a very complex formula. But actually, the formula is very simple because it's logical. So I'll tell you how it's logical. Basically, TP represents taxable perquisite for current year. So I'm going to identify what is a taxable perquisite for current year. Okay. So if it's financial year 22-23, I'm going to identify for financial year 22-23. My first exercise is PC by 2. What is PC? Employer contribution. That is principal contribution. Principal are articles. When you have an article, who's your principal? Principal is your boss. Principal is your employer. So principal contribution. So remember PC as principal contribution. So it's nothing but the employer's contribution. Employer's contribution. Please remember, employee contribution is already discussed in PF provision itself. What we are discussing here is employer's contribution. There it was 2.55, here in a 7.5. Please see there is a pattern, 2.5, 5, 7.5. In regular PF, there is employees contribution. We said there are two limits, in excess of 2.5 lakhs, in excess of 5 lakhs. Here we are saying in excess of 7.5 lakhs. This is employer's contribution. So employer's contribution in these three less 7.5 lakhs. Why are we reducing 7.5 lakhs? Because up to 7.5 lakhs, there is no perquisite. Only in excess of 7.5 mattumna perquisite. So if your amount accounted in this year is 8 lakhs, accounted in the year is 8 lakhs, you take 8 lakh minus 7.5 lakhs, so which is 50,000, So 8 lakh is the actual contribution, 7.5 lakh is the limit. So excess contribution, so PC is nothing but contribution by the employer, which is nothing but the excess contribution over 7.5 lakhs during the previous year. And you're dividing by 2. Why? Because month on month you contribute April, May, June, July till March. So you're taking an average. How are you taking an average? You're just dividing it by 2. You're just dividing by 2 to get an average. So now you get what is your yearly contribution. You divide it by 2, get the average contribution. On that average contribution, you are applying R. What is R? R is nothing but I by FAV G. Already formula confusion. Now there is one more formula in that. What are they saying? R is nothing but I by FAV G. I by FAV G. So what exactly you mean by FAV G? I represents income accrued during previous year. That is the accretion. Whatever is income during the previous year, I take that. I divide it by average of opening and closing balance in the previous year. So I take 1st April balance, I take 31st March balance. 1st April 22 balance, 31st March 23 balance. I divide it by 2. I get average. So FAV G is nothing but average. AVG is average. F is the current financial year. F is current financial year. So FAVG. So F stands for present financial year. Financial year's average. So what do? I average opening and closing divide by 2 of the previous year. So now this is my average rate. So what am I doing? I'm dividing my income. I'm getting my average balances, average balance. Now, if I divide this 2, I get a rate. So I get the average income rate, average interest rate. So what do I get? I get average interest rate. How do I get? I divide income by my FAVG. So this is the first part of the formula. What is TP1 and PC1? TP1 is taxable perquisite for the till 31st March 2020. That is previous year. So till the previous period. So from 1st April 2020, from 1st April 2020 to 31st March of preceding previous year. So 1st April 2022, 31st March 2022, I apply same. I apply this. I apply these. That is PC by 2 into R. I apply that. I get taxable perquisite PC1. I get PC1 by applying this formula for the previous period. And what about TP1? TP1 is what? I calculate this taxable perquisite. So now I apply this for the earlier year. I calculate PC1. So PC is here. I calculate TP1 using this formula. So I apply that and get for the previous year. I apply the current rate. So now I'll get old year's accretion, current year's accretion. If I add these two, I get the perquisite. So this is what is basically my total taxable perquisite. So I have calculated this based on this assumption. So you can always go through this formula and understand. Please remember, it is very simple. You're just calculating the current year accretion. What is your income attributable? You are also calculating for the previous period. That is from 1st April 22, 31st March 2022. You add both. So that's all. It's very simple. Probably you can go through and understand it. Considering this marathon session, I will not be able to repeat the provisions again and again. And I'll have to feel sorry for that. So we will move on to the next provision. So that is section 10, clause 13. We are going to discuss about superannuation exemption. So any fund contribution from the superannuation is exempt, but there are some conditions. What are the conditions? Any payment received from employee from an approved superannuation fund is exempt if on the death of the beneficiary to an employee in lieu or in commutation of an annuity or his retirement after a specified age or becoming incapacitated. So I have crossed the age or I have become incapacitated, which means I'm not capable of handling it anymore. So, or by way of refund on contribution of death of a beneficiary on account of employee under pension scheme. So from superannuation fund, I'm transferring to pension scheme, NPS. This is also allowed. It could be death. It could be the employee has become incapacitated, or it is refund in the case of death of a beneficiary. So in all these situations, it is not during employment, not basic retirement. You have to remember only two things: not during retirement, not during employment. So these two are not allowed. So during this, it is completely taxable. It is 100% taxable. What we are saying is only situations where it is beyond happening. So death or incapacitation, and the mari mattumda, it is basically taxable. Okay, moving on. Other perquisites that are taxable for all. I will list out various things. These are all covered as thing. So I'll read one by one. There is nothing much to talk about it. Telephone. So if employer provides telephone to the employee, employer provides telephone to the employee, it is tax free for all. It is tax free for all. So to an employee, it is resident. Transport facility, transport business. So someone is in the business of transport. They are transporting their own employees. It is not perquisite. So I have a business. I am into the business of transport. I am transporting employees of my business. So that is not perquisite. Privilege part or privilege ticket provided by the Indian Railways to employees. Not every company, it is only for Indian Railways. Perquisites allowed outside India by the government to the Indian citizen. Employees' contributions to staff group insurance. So group insurance scheme, that is also not there. Provided by accident policy. Employer paying insurance for accident policy is not there. Refreshment provided, tea, coffee, snacks provided during employment, during working hours. Working hours is from 9:30 to 6:30. Now, between that time, if you're giving any refreshments, it is not taxable. Subsidized lunch. So any food provided during the working hours, is not taxable, provided the meal is valued up to 50. So anything beyond 50 will be taxable. There are two thoughts to it. One says up to 50 it is not taxable. Excess of 50 alone is taxable. The other says not just 50. If 60 is given, entire 60 is taxable. Now we have to take a stand. My suggestion would be in the examination for you to take one single stand for all such provisions. So what I want you to do is take in excess. For example, when it says up to 50 per meal is not taxable, if you say the value of meal is 60, you exempt 50, you tax 10 alone. Because it is only an opinion. So you can write a note saying that whatever is in excess of 50 is basically taxable. Up to 50, it is not taxable. And this is not available in new tax regime. Which means there is no 50. The entire thing becomes, the 50 is not applicable. So the entire thing becomes taxable. There is no relaxation. So it is not tax-free. Recreational facilities, including cup facilities to all employees, is not taxable. So please remember the word says all employees. So when I'm giving a facility, I should give it for all employees. I should not restrict to selected employees. Adhe training of employees for boarding, on board, training, refresher course or anything is also not taxable. Some payable by an employer to RPF or ASAF is also not taxable. Leave travel concession provided to Judge of High Court and his members are completely exempt. For others, it is discussed separately. So it is provided to Judge of High Court or Supreme Court. It is fully exempt. For others, it will be discussed. Subsequently. Medical facilities also will be separately discussed. Rent-free official resident to Judge of High Court or Supreme Court. We already said accommodation, providing accommodation is taxable perquisites. But if it is provided to a Judge of High Court or Supreme Court, it is not taxable. It is tax-free. Rent-free unfurnished to officer of parliament or opposition in parliament or union minister. So for all of them, if an accommodation is given, then for example, you would have seen in various locations. In Chennai, you have it in Greaves Road, you have it for ministers. Delhi also, I think some Jantar Mantar. So every location will have such places where house is being allocated for the member. So such for them, it is not taxable. And any convenience facility to Judge of High Court and Supreme Court, it is not taxable. Here also, this is not available in new tax regime. So if you're in new tax regime, this becomes taxable. Whatever is provided to High Court or Supreme Court judge is also taxable in this situation. So this is about what are all is tax-free for all. Common things here is probably only these two. That is your leave travel concession and medical facility might be questioned. Rest of the things are not something very common. Only thing is, please remember, if words like recreation, club says that it is for all the employees, if you have 1,500 employees, all 1,500 can use the club facility, then it is not taxable. It is tax-free, but it's only for specific people, then it becomes taxable. Please remember this difference. All employees, selected employees. Please remember the difference. If something is provided to all employees, it is not perquisite. Okay. We said we'll discuss leave travel concession. We'll come to that. As we said, it is also not applicable for new tax regime. It is not applicable for new tax regime. So you are basically traveling to any place in India. You are taking leave or you're temporarily retiring and going, or you're terminating and coming back. So all these situations, basically you're traveling. So this is not important. So this portion is not important. We'll skip this part. So basically traveling to any place in India is, so we'll skip this part. So any place in India, what is the condition? They must be citizen as well as non-citizen, which means it could be anyone. It is applicable for self or family. So family means spouse, children, dependent parents, brother, sister. Spouse, children, dependent parents, brother, sister. So all of them are covered here. And when you say children, maximum of 2 children is covered. Maximum of 2 children is covered. And their date of birth must be after 1st October 1998. 1st October 1998. Only then they're eligible people, and is not applicable for multiple birth. I'll not get much into this. Basically, when you are twins, for example, first kid is one kid, second kid is a twin, which means even though now the total number is 3, all 3 is eligible. All 3 is eligible because the first one was only one kid. When the second kid was born, it was a twin. So in that case, it is allowed. So that is what you mean by multiple birth. Very rarely tested in exam. So we'll skip this part also. Limit of exemption. Amount is also given, number of journeys. So there are 2 types of limit. One is amount, another is number of journey. What is the number of journey limit? 2 journeys in a block of 4 calendar years. Block of 4 calendar years. So it's not previous year, it is calendar year. So current block is between 2022 to 2025. It is 2022, 23, 24, 25. In these 4 years, you can travel twice. But if you're not able to travel, in the previous block, you can carry forward one alone. So between 18 to 21, between 18 to 2021, in that 4 years, if I'm not traveled 1 year, if I'm not traveled, I have traveled only once, I have not traveled twice. In that case, the second can be carried forward. So in this case, the third one will become 3 travels. 3 travels in 22-25. So this is what is it. One can alone be carried forward. What about the monetary limit? Basically, in short, you have to take the airfare of the shortest route. Airfare of the shortest route. Train shortest route, first class AC fare. Or if there is no train available for any other public transport, shortest route, first class ticket cost. If none of this available, air is not available, train is not available, road is not available, any other mode which is equivalent to the train fare. So equivalent to the train fare for such distance. So if I'm traveling 450 kilometers, I take an equivalent route. I compare what is the railway fare and I take that. So that is the monetary limit. So please understand this is also not available in new tax regime, which means it's entirely taxable. The next thing, a medical facility. It is slightly critical because it might be questioned very commonly. Please remember, medical allowance is fully taxable. Medical facility is a perquisite. So if the question says medical allowance, it is fully taxable. The question says medical facility, then you have to look into perquisites. So this is what we are going to see about perquisites. Please remember, we said it is tax-free for all. Now we have to understand what is tax-free. So following are tax-free, which means it's not perquisites. So hospital maintained by the employer. So the hospital itself is maintained by the employer only, and treatment is provided for employee or any member of his family or any members of his family. So treatment for an employee or any member of his family, if it's provided, it is not a perquisite. So hospital maintained by employee, treated for employee or member of family. So who's a family? Spouse and children. When you say children, it could be dependent, it could be independent, it could be married, the person could be unmarried, and also includes dependent parent, brother, sister. So spouse and children, no question of dependency, it's straight away included. Parent, brother, sister, they must be dependent. So if they are being treated in hospital maintained by employer, it is not a perquisite. And reimbursement of expenditure for employee or any member of his family, in any government or government approved hospital in respect of prescribed disease or illness in respect of COVID-19. So this was introduced on 1st April 2020 with retrospective effect from 1st. So it was introduced in Finance Act 2020 with retrospective effect from 1st April 2020. So what is it? I am treating myself or my family in any government hospital or something, institution, I'm treating for a prescribed disease or COVID-19 illness. I'm treating for a prescribed disease or COVID-19 illness. This expenditure is basically not a perquisite. And next is any insurance premium on health of an employee under scheme specified. So whatever insurance premium employer is paying on behalf of employee is not a perquisite. Similarly, employer is not taking insurance, but I have taken insurance, employer is reimbursing. So that is also not covered. It is not a perquisite. So generally, medical insurance policies taken by the individual is covered under ATD. If that premium is reimbursed to me by the employer, then it is not a perquisite. Any expenditure incurred outside India for the employee or the family for medical treatment, including stay, the limit is, it is exempt if it is within the RBI limit of 2.5 lakhs US dollars. So RBI says up to 2.5 lakhs US dollar, your medical treatment is not taxable. Medical treatment refers to both treatment, including stay. And what about travel? Self plus one attendant. So travel could be for the per employee plus one attendant, that is patient plus one attendant. And it is exempt. It is exempt if the gross total income before this expenses does not exceed 2 lakhs. How big? Most of the gross total income will be more than 2 lakhs. So when you say 2 lakhs, what is your salary amount? Monthly 20,000. So monthly, not even 20, it's around 16, 17,000. So which means if your gross total income is more than 2 lakhs, it becomes a taxable perquisite. So it's not a perquisite only if your gross total income is up to 2 lakhs. So that is for the travel. That is only for the travel where you say for the self plus one attendant, you can claim this. And we also discussed who is a family for this. So if you satisfy all these, you become this is not a perquisite. So if you follow one of this, it's not a perquisite. And in August 2022, they have given conditions for COVID-19 repercussions. COVID-19. So what is the thing? So this is also something new for you. So COVID-19, you have to submit your COVID positive report or the medical report from the hospital that is treating you. So either have to give a positive report, that is the COVID test, or medical report. I need to give all the necessary documents conducted by the hospital within 6 months from the date of treatment. So which means if I have COVID today, I should have been treated within 6 months. Only that period treatment is considered as a treatment. So all necessary documents within that 6 months. Please remember, it is not any time. From the COVID illness, within 6 months, I should have been treated. That analysis, diagnosis, all those needs to be provided. And a certification in respect of all expenditure incurred on the treatment. So someone has to certify. So basically, let's say a chartered accountant has to certify an employee. So certify basically from the hospital also is okay. So certification in respect of all expenditure incurred on the treatment. So this certification needs to be provided for this. So these three are the conditions to claim your illness, on COVID-19. So any expenditure on COVID-19 for self or family is allowed, but you need to satisfy these conditions. 3 conditions: COVID report, medical report, necessary documents of diagnosis, and a certification saying that these are all the list of expenditure incurred on the treatment. If these 3 are provided, then automatically you are eligible for exemption on that perquisite. So it's not a perquisite, there is an exemption. Otherwise it is fully taxable. So this is all about your taxable for specified employee. So just give me a minute. So next we will discuss about perquisites of specified employees. So what do you mean by specified employee? We said that there are certain perquisites which are taxable only for specified employee. So what exactly is specified employee? So specified employee is typically what you call it as. There are 3 components to specified employee. First component is a director. You are a director anytime during the year. So you could be a full-time director or a part-time director, but you are a director in that company. And then, so next is you are having substantial interest. So when you say substantial interest, you are owning more than 20% of voting power in that entity. So if you're owning more than 20%, that is at least 20%, then you are called as you are eligible, you are called as a specified employee. Last one is a very interesting thing, drawing salary. How much? 50,000 in a year. So even if you are getting 50,000 in a year, 50,000 in a year, please remember it's not monthly, it's yearly. 50,000 in a year, automatically you are treated as specified employee, which indirectly income tax is telling you all the employees are specified employees. Because when will you have 50,000? When you have 4,250 or something, right? So if you have more than that per month, so everyone's salary will be more than 4,250, or at least anyone who's receiving a perquisites, their salary will be more than 4,250. So 50,000 in a year. So the standard deduction limit itself is 15,000. They say after section 16 exceeds 50,000, which means if my amount is 1 lakh, I take 50,000 standard deduction, balance 50,000. So we can keep the amount as 1 lakh. So after standard deduction, if my salary is 50,000 and more, exceeds 50,000, I become specified employee. And when calculating the salary, I should exclude all non-monetary benefits and monetary benefits exempt under section. So I should exclude this and calculate. Now, when you say specified employee, what all are covered? It is covered for provision of sweeper, gardener, facilities of use of gas, electricity supplied by employer, free or concessional ticket, use of motor car and educational facility. So this is what we are going to understand. First, we'll understand about the residential accommodation. So these are all only applicable for a specified employee. Specified employee are 3 categories: director, owning more than 20% share, and your annual salary is more than 50,000 after standard deduction. Now, with respect to this residential accommodation, there are 4 things that is listed here. First thing is, it is for government employee. So building the property is owned by the government employee. The property could be owned by anyone. It is being given to the employee with the affairs of union or such state. So the government employee is getting a house to stay from the government itself. So license fee determined by the central government or state government. Please remember, this is for unfurnished. So now whatever we are calculating is for unfurnished. We will not talk about furnished. We will only talk about unfurnished. So if you are a government employee, the license fee, first thing. Second thing, the property itself is owned by employer. Take the census conducted in 2001. If it is more than 25 lakhs, then 15% of salary. If it is more than 10 lakhs, then 10% of salary. In any one case, it is 7.5%. So 15, 10, 7.5. 15, 10, 7.5. Population is more than 25, 15%. More than 10, 10%. More than 10 lakhs, 10%. So that is easy to remember. More than 10 lakhs, 10%. More than 25 lakhs, 15%. In any other case, it will be 7.5%. Now, what exactly salary refers to? Salary refers to salary, dearness allowance forming part of retirement, any taxable allowances, any bonus, any commission, but do not include any other allowances or any other perquisites. So only these: salary, dearness allowance forming part of retirement benefit, any taxable allowance, bonus, commission. All these 5 should be considered. Everything else should not be considered. So on that, if the population is more than 25 lakhs, you apply 15%. If the population is more than 10 lakhs, you apply 10%. For everywhere else, it is 7.5% of salary. What about it is leased by employer? You take the lease rent or 15% of salary, whichever is lower. So I take lease rent paid or 15% of salary, whichever is lower is basically my taxable perquisites. So that becomes my taxable perquisites. Whatever we are seeing is to identify how much is taxable perquisites. What about if the employer gives me a hotel at the time of transfer? I'm shifting from Chennai to Mumbai. Employer says, I'll give you a hotel, you can stay in that. In that case, for not exceeding 15 days, it's not a perquisites. But in case if it is more than 15 days, 24% of salary or actual hotel charges, whichever is lower. These two are same. These two are same. Instead of lease rent, here it's hotel rent. Lease rent, hotel rent. Or 15% of salary, here 24% of salary, whichever is lower. So for leased by employer, 15% of salary or lease rent paid. For hotel, 24% of salary or hotel charges paid, whichever is lower. It is not applicable up to 15 days. And this I'll leave out, I'll not explain. And if furniture, what if it is furnished? Whatever we saw till now, it is unfurnished. What if it is furnished? If the asset is owned by the employer, if the asset is owned by employer, 10% of the cost of the asset should be considered as value of perquisite. In case if it is hired, of course, the higher charges, no doubt about it. If it is rented, take the rental charges. If it is owned, take the 10% of cost. It's like 10% depreciation. 10% of cost needs to be considered. And if in case central or state government is basically deputing someone to anyone else, that property, that is the place where you are staying, will be assumed to be owned by employer. This is also basically not much important. So what is important is only this furnished. So I'll take this alone. I'll not cover these two because it's basically not that important. We'll leave this. Okay. So perquisites. What is the perquisite value? You take the value of unfurnished. It is calculated here. Then take furnished, which is calculated here. So take this. Then minus recovered. Everywhere you need to minus the recovered thing. So anything that is recovered from the employee should be reduced. So this is what will give me the taxable perquisite. So it's unfurnished plus furnished minus recovered. Next, one of the most important perquisites is motor car. Okay, motor car. So first we are going to discuss when it is not a perquisite. When employer has given to employee, exclusive office use, 100% it is used only for office, exclusive office use. And it is not a benefit given free or at concession. So there is no benefit here. It is exclusively used for office purposes, for office activities. So employer is given to employee. So there is no benefit that is given free or at concession. Whatever is given is for the purpose of carrying out office duty. In that case, it is not at all a perquisite. Now, in some cases, it is perquisite only for a specified employee. We already saw who's a specified employee who's drawing huge salary. What is the huge salary? 50,000 yearly. So if someone is drawing more than 50,000 in a year, they automatically become a specified employee, apart from being a director on 20% shareholding. Now, this specified employee, perquisites of specified employee, is when employer is giving. Please remember, employer is giving to employee. Employer is giving the car to employee. It is used for both use. It is used for both the use, both personal and business use. Employer is giving to employee. It is used for both the personal and business use. That is your perquisite for specified employee. What is the next thing? Perquisite for all employees. So it is owned by the employee or the family. It is owned by the employer family. So if you take me, it could be me or my family who's owning the car, but I'm using it for both personal and office use. Used by employee and family members. Employer reimburses the expenditure. So in a year, I'm spending, in a month, I'm spending, or in a year, I'm spending fuel, repair and maintenance. All of this is reimbursed to me by the employer. So in a year, let's say fuel plus repair and maintenance, I have spent 95,000. Employer gives me 95,000. Then it becomes a perquisite because it is reimbursed by the employer. So this is for all employees. So now I need to understand whether it is a perquisite. In case if it is a perquisite, I need to understand whether it is for specified employee or for all employees. So when you say specified employees, employer gives his car to employee. All employees, it is my car, which I'm using for both office and personal. Company is giving me money for that, for maintenance. So that is what's up. So if you have more than one car, the first car will be treated as partly business, partly private. Partly business, partly like this. Partly business, partly private. Other cars will be considered as exclusively private. And of course, you have to maintain document. If it is normal wear and tear, when you say, and subsequently we'll be reading about normal wear and tear. When you say normal wear and tear, it is 10% per annum on actual cost. And what about the period? Month includes part of a month. So this is one of the important things. Generally, when you say month, for example, someone gives me a car on 29th September. How many days I'll be using it in September? 2 days, but it's still 1 month. So when you say part of the month, even 1 or 2 days in a month will still be called a month only. So that is what this period is all about. So now we'll get into the situation. So certain things are not perquisites. When is it not perquisite? When the employer has given to employee, it is exclusive office use. That is not a perquisite. When is specified employee? Employer has given to employee, both use. Employee's own car reimbursed by employer, it is for all employees. So please remember this. So first situation, what we are going to understand is, it is for motor car that is owned or hired by employer. Owned or hired by employer. And it is wholly personal. Wholly personal. So which means it's automatically a perquisite. Now, what should be included? What should be reduced? So cost to employer should be included. What do you mean by cost to employer? Actual expenditure, actual fuel, actual repair and maintenance, actual driver, chauffeur is driver, actual driver cost. All this should be included, plus normal wear and tear, that is 10%. So actual expenditure, actual driver cost, plus 10% for normal wear and tear. So that is what you have to charge it for as a perquisite. If you have recovered anything from the employee, that must be reduced. Either not repeat it, in all the provisions, please remember, if you have recovered something from the employee, it is not a perquisite. If you have recovered something from the employee, that is not a perquisite. To that extent, it is not a perquisite. Now, what if it is owned by the employee, but it is any other automotive, which means it's not motor car, but it is used for both personal and office purposes. So again, actual expenditure, documents needs to be maintained. You have to minus 900 per month. So it is owned by employee, which means it is for what? All employees. When you say owned by employees, it is for all employees. So it is actuals minus 900 per month. Actual, you take actual expenditure. You don't take normal wear and tear. Yeah, because it is owned by the employee. So you don't take normal wear and tear. You only take the actual expenditure. It will also include the driver cost. So actual expenditure incurred by the employer minus 900 per month will be for owned by employee, any other automotive, that is not motor car. No, it is owned by employer only, but it is not fully private. It is used for both office and personal. So this is also what it is for: specified employees alone. It is only for specified employees. Now, expenses met or reimbursed. So basically, the expenses of maintaining the car is either directly given by the employer or reimbursed by the employer. So employee is not spending. So if employer is spending, you have to take the cubic capacity of the car, 1.6 liters or 1600 cc. 1.6 liters or 1600 cc. So it is 1800. So if it is not exceeding 1600, it is 1800. In case if the cubic capacity exceeds 1600, it becomes 2400. If you are being given a driver, you have to add 900. So 1800 per month or 2400 per month plus 900 per month. So everything is per month. So up to 1.6 liters, it is 1800. But if expenses is met by employee, which means employee meets the expenditure, it is not reimbursed. So it is not reimbursed. So in that case, it is only 600. This is only 900. And chauffeur, same. You have to add 900. So that is what you have to do, remember. So basically, 1800 is when your cubic capacity is more than 1600. 600 when it's up to 1600. 600 in case where expenses are met by the employee. So 1800, 2400, 600, 900. In both these situations, chauffeur is 900. Now, what if motor car is owned by employee? You take the actual expenditure reimbursed by the employer minus, please see, perquisite specified for car owned and expenses met by employer. So you have to take the actual expenditure. You have to deduct this. So if the car is owned by employee, we said it is applicable as a taxable perquisite for all. How much is a taxable perquisite? I take the actual expenditure. I take the actual expenditure for that car. That is when you say actual expenditure met by the employer. Actual expenditure met by the employer. Now minus perquisite specified for car owned and expense met by employer, which is this 1,800 or 2,400 or 900. So that is what is your actual expenditure or deduction. So please remember what I'm deducting. I'm deducting whatever is reimbursed by the employer. That is 1,800, 2,400 plus 900. Okay. The other perquisites that we'll be seeing, is various other perquisites. As I told you, most important is motor car. Accommodation is important. We saw about accommodation, what percentage and all. And now these perquisites, all these perquisites, we said it is only taxable for specified employee when it is engaged by employer. So if there is a domestic servant, the domestic servant is engaged by the employer, then it is applicable only for specified employee. But if the employee himself is keeping a domestic servant and the employer is paying, then it is taxable perquisite. It is a taxable perquisite for all situations. So category, it could be a sweeper, it could be a gardener, it could be a watchman, it could be a personal attendant, etc. So actual cost, whatever employer is paying, minus amount paid by employee. So if per month they're paying 5,000 to the sweeper, employee is giving 1,000, 5,000 minus 1,000, 4,000 is a taxable perquisite. So amount cost of the employer minus paid by the employee, And what about concessional education facilities? Here also, it is for all employees if it is paid on employee's behalf. But if it is specified employee, it is free of cost. If it's free of cost, it is only for specified employee. It is paid on employee's behalf, it is all employees. So this is what it is about. So perquisite, if it is owned by employer or a free education or the cost of education in the similar institution. For example, if I'm studying in Adayar, Chennai Adayar, the nearby Adayar, whatever the other schools are there, what is the cost? Education in similar institution or a nearby locality. So I need to take that only. Minus recovered. So of course, I need to reduce whatever is recovered. This is a common practice. If you've recovered something, you need to reduce it all now. No perquisite if cost of education per child does not exceed 1,000. So if it is not exceeding thousands, it is not a perquisite. So if it exceeds 1,000, the amount that it exceeds 1,000 alone will be treated as a perquisite. So whatever is in excess of 1,000 will be treated as a perquisite. And if it is not owned by the employer of free education, whatever is the expenditure minus recovered from employee. So this is a perquisite. Children education allowance, hostel education allowance, hostel allowance, all that is per month 100, 300. No, but it is not like that. It is giving free education or giving education in the employer's school itself. So in that case, what happens? Cost of education minus recovered up to 1,000, it is not there. When you say cost of education in the nearby locality. In any other case, whatever is actual expenditure minus recovered from employee. Next, free or concessional ticket. So here, employer engaged in the carriage of passenger of goods. Please remember, it is only for transport companies. So the company is involved in carrying passenger or goods. Employer is involved in carrying passenger of goods. Now, what is the benefit? Benefit is given to employee of a family member or family member. So employee or family member, it could be personal journey or concession fare. It could be free or concession fare, but it is personal journey. It is not official. It is personal journey. So in any conveyance, owned, leased, or made available by any other arrangement. So basically, I am giving a transport system. I am running a transport system. I am asking either the employer or the family member to do a personal journey. So this is called as a perquisite. What is it? What is a perquisite? Value offered to public minus recovered from employee minus recovered from employee. So whatever is value offered to public, which means if as a stranger, if as a third party, I'm traveling in that road system or bus or whatever it is, whatever cost they would have collected from me, that minus recovered, In case it is airline or railway employee, it is not a perquisite at all. So this only for road transport, it becomes a perquisite. For airline or railway, it is not a perquisite at all. What is a perquisite? Value offered to stranger, that is value offered to public, minus recovered from employee, This gives you what is the actual perquisite. So as you see, everywhere you will have a term which is say minus recovered. Next, interest free or concessional loan. So this is a fringe benefit. So what do they say? Loan to employee. Loan has been given to the employer or the family member. It is provided by employer or any person on behalf of the employer. So employer himself can give or on behalf of the employer. So what is a perquisite? You take the interest rate on 1st April of previous year. So for example, if it's financial year 22-23, you have to take the rate on 1st April. Interest on rate charged by SBI. So what is the rate of interest charged by State Bank of India? What date? On 1st April of previous year. So for your examination, it is 1st April 2022, the rate charged. Will the exam give you this rate? Yes. A question paper will tell you what is the rate adopted by the SBI. On maximum outstanding monthly balance. Please remember, it is maximum outstanding monthly balance. So what do you mean by monthly balance? Every month there will be a closing balance. Maximum outstanding monthly balance. So in a month, if there are 30 days, the date in which you have the maximum date. So you take that, you apply the interest rate. Similarly for every month. Every month you take that date on which there is maximum outstanding. You have to apply this interest rate on that minus usual, recovered from employee. And it is not a perquisite. If it is for medical treatment of prescribed diseases or loan amount is less than 20,000. So it is not a perquisite. The loan amount is less than 20,000 or it is borrowed for prescribed diseases. So otherwise you have to calculate interest. As I told you, take the SBI interest rate applicable on 1st April of the financial year. Apply the interest to month-on-month balances, maximum outstanding monthly balance. So in this, if it is October, what is the maximum balance? I apply that interest rate. So similarly, I have to do for rest of the months. We'll move on to the next provision, traveling, touring, and accommodation. So this is similar to leave travel concession, but it is not exactly leave travel concession. So it is other than leave travel concession. So what is the thing? Actual amount of expenditure, whatever is met by the employer or reimbursed. If you actually look at it, everywhere they use the word met or reimbursed. So it could directly be paid by the employer or it could also be reimbursed by the employer. Both needs to be considered. Next, facilities maintained by employer. Value of such facilities offered by other agencies. So in case the facility itself, let's say there is ITC hotel, employee of ITC is coming and staying in that hotel for personal thing. Now, whatever ITC would have charged for anyone else in that hotel would be the charge. So value of such facilities offered by other agencies could be taken, or my agency itself for third party could also be taken. So I could take such a value and it is applicable for whatever is will become my perquisites. Now, apart from that, now I am going on an official tour. Who's accompanying me is my spouse. So my spouse is accompanying me. So expense on family member will also be the actual amount of expenditure. Whatever is the actual amount should be considered as expenditure. So if I'm going on an office trip, I am being accompanied by my spouse. Whatever is the charges for my spouse will be covered as perquisites in my name, under my name. And sometimes what happens is the company will send you for some certain things like conference or exhibitions or something. So company will send you. Now, when I go there, let's say the exhibition is for 2 days, Thursday and Friday. What I tell the company is, I will also stay there on Saturday, Sunday. It's a very good place to look at it. So I will sightsee. I'll take vacation for 2 days, that is Saturday and Sunday. I'll come back on Monday. So now Thursday and Friday is official. Saturday and Sunday is personal. So what I do is, if official tour is extended as vacation, limited to expenses on such extended period. So now I am going for 4 days. Thursday and Friday is official. Saturday and Sunday is personal. So I need to proportionate the cost. I need to take the cost only for Saturday and Sunday and treat it as perquisite. So that is thing. Next, free or concessional food. Free food, which is non-alcoholic. Alcoholic is definitely not considered, or it becomes perquisite. Amount of expenditure minus recovered. So it's a common thing. Minus recovered is a very common thing. But for the two things in motor car, everywhere you will be reducing recovered things. And it is not a perquisite in the new tax regime. It is not a perquisite in new tax regime. And we said up to 50 per meal, it is not taxable. When we said that, we said there are two standards you can take. You can either take up to 50, it is not perquisites. Above 50 alone is a perquisite, or up to 50 is not a perquisite. If it crosses 50, the entire amount is perquisites. There are two stands that you can take. I asked you to take a stand where I say, if it is 50 per meal, and you're getting 60 rupees, 50 is not a perquisite, 10 rupees is a perquisite. But please remember, you have to very clearly write it in a note saying that you have taken this position, 50 is not a perquisite, additional 10 alone is a perquisite. So you have to clearly specify. Tea or snacks is not a perquisite. Free food during working hours is also in remote area. Is also perquisite. So same free food, but if it is provided in remote area, it is not a perquisite. So these are the situations where it will not be considered as perquisites. Next thing that we'll see is gift voucher or taken in lieu of such gift. So basically, whatever value is received by the employer or family member from employer is taxable. Any gift, Amazon gift voucher, Flipkart with Big Billion Day is coming, I'll give you Flipkart voucher. Great Indian Festival, and Amazon is coming, I'll give you a voucher. So whatever is value received by the employer or the family member from the employer is basically a perquisite. It shall be nil if such values below 5,000 in aggregate during the previous year. So basically it says up to 5,000, it's not a perquisite. Now again the question comes, what if it is 6,000? Here also you can take a stand that up to 5,000 is not a perquisite. Above 5,000, you take whatever is the amount. So if it is 6,000, 5,000 is not a perquisite, 1,000 is a perquisite. So you can split, but clearly write note saying that you have taken the stand, because both viewpoint is accepted. But you have to tell through note that you have taken this way, because note making, writing notes in your question paper answer sheet is very vital for answering the problems. So that is your gift voucher or taken in thing. Credit card expenses. Of course, if it is for whatever, including membership fee, annual fee, whatever it is, for the employee provided by employer. So the credit card is given by the employer. Whatever is the actual expenditure minus recovered is basically taxable as perquisites. Annual or periodical fee in a club for employee minus recovered. So that is also, say, expenses also perquisite. Periodical fee is also perquisite. So that is also what is not perquisite. If it is exclusively for office purpose, it is not perquisite. Initial corporate membership. So if I have to deposit 5 lakhs for first corporate membership, that 5 lakh is not a perquisite. Initial fee is not perquisite. Subsequent annual fee, membership fee, any expenditure becomes a perquisite. Similarly, it is not a perquisite if it is for all employees. We have already discussed this point. Use of movable asset. So basically, when I say movable asset, I'm talking about a situation where the perquisite, where the asset is owned by the employer. If it is owned by the employer, for example, it's not a car, of course, it's some other asset. So let's say, what can we say? Let's say refrigerator. A refrigerator is given to the employer. Now the refrigerator is owned by the employer. So in that case, 10% of actual cost. Normal wear and tear, whatever we saw in motor car, normal wear and tear is applicable. If it is hired by employer, very straightforward, higher charges. We need not even remember, it's straightforward. If it is higher charges is your perquisite. If it is owned, 10% of actual cost becomes thing. And of course, you have to reduce what? You have to reduce whatever is recovered. Very straightforward. not a perquisite. Laptop and computers are not perquisites because today everyone gives laptop. So if there are 1,000 employees in an organization, all 1,000 are given laptop or computer. So basically, laptops and computers are not use of perquisites. It's not a use of movable asset. But next we are going to see about transfer, that is selling an asset. So selling an asset is basically depreciated value minus recovered from employee. So what are the things that you're talking about? If it is a computer, 50% on WDV for each completed year. For each completed year. So for each completed year, I'll apply 50%. So I will calculate the WDV. I'll calculate WDV. Whatever minus recovered, if let's say the product was worth 1 lakh, okay, 1 lakh. After 2 years, I'm selling. First year, the depreciation will be 50%, 50,000. So balance 50,000. Second year, I'll provide another 50%. So now it will become 25,000. In the third year, it becomes 25,000. Now I'm paying my employer 5,000. So 25,000 minus 5,000 becomes my perquisite. So this is what I need to do. If it's motor car, I need to provide 20% on WDV. Same thing, but it is 20%. If it is any other asset, 10%, but it is straight line method. If it is any other asset other than the computer or motor car, it will be 10% on straight line method, like your normal wear and tear, 10% on straight line method. So any other benefit, if it's something other than all these, whatever we have discussed, you have to take whatever is the cost to employer as reduced by employee's contribution. So you take the cost minus the employee's contribution. Sweat equity share. So it's called as ESOP, employee stock option plan. So sweat equity share is the shares allotted to you for sweating, for doing extra in your organization. That is what is called sweat equity shares. If the stock exchange is listed on stock exchange, if what the shares that are allotted to you is listed on stock exchange, and it is listed only on single exchange. For example, when you say single exchange, it could be Bombay Stock Exchange, National Stock Exchange in Britilia. If it's listed in only single stock exchange, whatever date it is being allotted to you, average of opening and closing on that date. Multiple exchange are the average of opening and closing in the place where highest volume is recorded. Most of them buy from National Stock Exchange. So particular company is listed both in Mumbai Stock Exchange and Bombay Stock Exchange and National Stock Exchange. The place where it is traded more will be taken. So of course, it will be mostly National Stock Exchange. If it is not traded, now the closest date. If today it's a holiday, it is not traded up, the next immediate closest date. So previously or afterwards, the immediate date in which it is traded. So that is what you have to take. In case if it is not listed in stock exchange, which means it's unlisted, fair market value determined by the merchant banker, and validity of that is 180 days. So fair market value determined by the merchant banker within 180 days before the date of such exercising. So the date on which you're exercising, you should have got it within 180 days prior period. So before that, and anything recovered should be settled, of course. What do you mean by closing price? That is opening and closing price. Closing price is the last settlement, last sale that has been made. In case if it is not an equity share, then again valuation from merchant banker within 180 days, we have to get whatever is recovered from employee should be adjusted. So it's all straightforward. And in case, what about the taxability? See, there was a recent amendment couple of years before. They said that tax on perquisite is to be paid in the year of exercising of option. But if it allotted by the current employer being an eligible startup, so if the one was given you this stocks is from a startup, then the perquisite is taxable in the year after expiry of 48 months. That is 4 years from the end of the relevant assessment year. So if it is financial year 22-23, 23-24, 24-25, 25-26, 26-27. So 48 months from the end of, so it will be only taxable in 26-27, relevant assessment year. So the assessment year will become 27-20 year, assessment year 27-28. So that is for first thing. Second thing, in which sale is made by the assessee. Before that, if I'm making a sale, that period itself, in which the assessee ceases to be employed. If I'm quitting that organization, then also it does not. So these three, whichever is lower. 4 years from the end of the relevant assessment year, sale of that asset ceases to be an employee. So whichever is earlier, in that year, this will become taxable. This will be treated as a perquisite. And next, we will talk about, so we have covered all the allowances and perquisites. So we have covered 17.1, 17.2 and 17.3. 17.1 was salary. We saw various allowances. which is about gratuity, leave encashment, your pension, provident fund, all these we discussed. Then we discussed profit in lieu of salary, something like your compensation for modifications, voluntary retirement, all that we discussed. Then we discussed 17.2, which is perquisites. We discussed about calculations of various perquisites starting from housing accommodation to sweat equity shares. Till that we discussed various things. Now we'll get into the deductions. So deductions, there are 3 deductions. So section 16(1)(a), 2 and 3. So standard deduction is basically 50,000 or amount of salary, whichever is lower. For new tax regime, this is not eligible. For your exam, for new tax regime, it is not applicable. Entertainment allowance, it is fully taxable for private employee. And then eligible employees can get deduction. Who is the eligible employee? Government employee. So we'll also remember ALP again. ALP can be remembered for everything and anything. So A is your actual receipt of entertainment allowance. Limit is 5,000. Proportion is 1/5 of basic salary. So whichever is least will be claimed as deduction. So this is only applicable for government employee. It is not applicable for anyone else. And then professional tax. Professional tax, in case if it is borne by employer. So if it is taken by the employer, it must be part of salary, then claimed as deduction. Part of salary, then claimed as deduction. So which means if I'm paying 2,000 of professional tax, if the employer is paying, it will be added first in the top as salary and then claimed as deduction. In case if it is borne by employee, it can be claimed as deduction alone. It can be claimed as deduction alone. So these are the difference. If it's employer, add up, reduce, deduct below. If it's employee, nothing needs to be done at the top, just deduct alone. However, maximum benefit of professional tax will be how much? 2,500 per annum. 2,500 per annum, and nothing more than that. Okay. The next thing that we'll discuss. So these are the things that it's about your deductions. 2 things that we discussed: your entertainment allowance and standard deduction. The next thing that we'll understand is relief under section 89. Relief under section 89. So when you say relief under section 89, section 89, I told you it is a relief we also discussed in VRS. So it is applicable for 3 situations. One, when you get arrears salary. Second, when you get arrears of family pension. Third is when you're getting VRS or termination benefits. So you get relief for these things. How do you get relief? So first, you have to calculate 81. What is 81? Compute tax with and without arrear. So if for example, let's take 3 years. Financial year 15, 16, 16, 17, 17, 18. For these 3 years, there is arrear salary given to me today, given to me in 22-23, given to me in financial year 22-23. So in financial year 22-23, I first compute tax with this arrear, with this 3-year arrear, then compute without this money, without this income. So with arrear, without arrear. So the difference tax, that is 81. The difference tax on the current year rate, tax rate is 81. What is 82? The respective year, 15, 16, 16, 17, 17, 18. For all these 3 years, I compute tax with this income, without this income, with this income, without this income. I calculate the difference, with minus without, with minus without. So that is 82. So 82 is for the relevant year, relevant tax rate, relevant tax rate. Here it is current tax rate. So now 81, what is 81? 81 is your tax basically, which is being calculated in the respective years, minus your arrears, whatever, with arrear, without arrear. So I take both. Similarly, I do it for current year also, I do it for earlier year also. So I do it for current year also, I do it for earlier also. So now 81 minus 82, whatever is 81 and 82 will automatically become my relief under section 89. So as I told you, this is only applicable for arrears of salary or advance salary, arrears of family pension, and then VRS. Only these 3 situations it is available. And relief under section 89 should be computed in this manner. First calculate 81, 82, and 82. 81 minus 82 will become your relief as such. So this is what is basically your tax as such is concerned. Now, These are all about your reliefs and other things, right? There is one more thing that we need to discuss. Exempt income. We said exempt income, it's a separate chapter, but of course we'll discuss now and then whenever there is something specifically discussed, we'll discuss it. So with respect to salary, there are some of the salaries which are exempt, which is discussed under section 10, clause 6. Okay, 10 clause 6. So this 6 is also section to determine whether you are a resident or non-resident, correct? So section 6 is a section which tells you whether you are a resident or non-resident. Now, section 10 clause 6 talks about non-resident salary, in these four situations. In these four situations, it is not taxable, it is exempt. So first, remuneration received by officials or embassies of a foreign state. So the person is not a citizen of India. The person is an official or embassy of a foreign state, provided the corresponding government official, should also be exempt. For example, in India, if there is an US embassy will pay tax there. Similarly, in US, there will be Indian embassy. So if US relaxes tax of US embassy here in India, India will release that. So correspondingly, corresponding government official resident. So if US relaxes its embassy's tax rate in India, India will release it in India. So that is what you mean by corresponding state. Then remuneration services rendered by foreign national employed by a foreign enterprise. So foreign enterprise has no business in India. An employee is sent here. Employee is paying paid remuneration. And such employee is not a citizen of India. All these four, the situation is that the person is not a citizen of India and typically is receiving salary outside India. So whatever remuneration services rendered in India by foreign national. So foreign national is receiving income in India. So this money is not taxable if the total number of days that he has been in India is less than 90 days. Total number of days he has been in India is less than 90 days. So and then the third one is salary of services rendered in connection with the employment on foreign ship. So there also stay does not exceed 90 days. Last one, foreign government employees come to India, they are staying for a specified training. So during their stay in India, they're doing some services for which the government is paying them salary. The foreign government is paying them salary. So when if such entity, where they are taking training is a government organization or a statutory corporation, then this is also not taxable. So these four are not taxable. How much importance in exam? Very rare situation only, but sometimes it has been questioned. Basically, it has been questioned selectively. It has been questioned. And last one, allowance or perquisite paid outside India. We already discussed this. Please understand that both this 10 and 6 is available for both regimes. So which means it is available under national tax regime also. It is available under national tax regime also. It is also available under old tax regime. So it is available under both these regimes. So this is all about the salary provisions. So whatever we have covered the salary in our real marathon session, no break, nothing. We have just discussed all the provisions applicable in salary. So hope this would have been a very good refresher for you. So with this, we'll wind up today's session. What we'll do is we will start tomorrow with the rest of the chapters. Probably we'll try to cover the rest of the heads of income with the tomorrow itself. We'll cover all the heads of income by tomorrow. Yeah. So with that, thank you for the wonderful session. We'll see tomorrow for the next session. Thank you.
Thank you so much, sir.